In the realm of personal finance, the challenges of 2023 sculpted a chapter of resilience and enlightenment, guiding investors through a metamorphosis fueled by dynamic trends. Now, the echoes of global geopolitical challenges, supply chain disruptions, and economic uncertainties acted as catalysts that shaped financial strategies throughout the year. Now, these challenges paved the way for transformative trends, including early investing, adaptive learning approaches, and strategic asset allocation, which have resonated with the aspirations of today's investors. So, as the sun rises across the financial landscape of 2024, the hues of change and innovation have begun to enrich this canvas. In a world characterized by unprecedented connectivity and technological prowess, personal finance now transcends traditional confines. And so, a deep dive into the trends shaping personal finance and mutual funds in this transformative landscape involves a journey where financial goals are not just achieved, but orchestrated with finesse and purpose. The winds of change continue to whisper tales of empowerment, urging investors to embrace a new epoch of financial prowess. So, this edition of Nivesh Mahakumbh extends an invitation to reflect on the trials of 2023 and resolves to chart a course for financial success in 2024. Good morning, ladies and gentlemen. I'm your host, Gautam Srinivasan, and we have gathered today for the Nivesh Mahakumbh 2024, where the focus will be on the theme of Financial Reflections 2023 Insights and 2024 Strategies. Now, this is a part of a one-of-a-kind investor awareness initiative launched by Aditya Birla Sun Life AMC Limited in association with Hindustan Times, and will delve into insights, strategies, and foresight to navigate the evolving financial landscape with poise and determination. We will begin the event with our national anthem. Indeed, an inspiring thought to begin this event as we strive towards the goal of achieving financial freedom. Time now, though, to listen to a rendition of the Aditya Vandana.
Aditya Savita Surya Khagah Bhusha Gabhastima Suvarna Sadrisho Bhanur Vishwareta Divakaraha Tattachami Karabhaya Hare Vishwakarmane Namah नमस्तमो विघ्नाय तुझये लोकसाक्षिणे जयाय जय भद्राय हर्षवाय नमो नमः सहस्रांश आदित्याय नमो नमः आदित्याय नमो नमः
And with the blessings of God and country, we begin this event. I'd like to invite Mr. Bala Subramanian, MD and CEO of Aditya Birla Sun Life AMC Limited, to deliver the keynote speech and start the day's proceedings. Over to you, Bala.
Namaskar and good morning to everyone to be part of today's Nivesh Mahakumbh event, which is nothing but creating awareness about investing in capital market and mutual fund in general. I'm also happy to share with all of you. This is our eighth such event with Hindustan Times. Our association with Hindustan Times have been more at the forefront of creating awareness about investing. I'm also happy to share this is our 32nd investor education event, which is a broad format, a large audience investor awareness event of Aditya Birla Sun Life Mutual Fund. And it's again is such a coincidence. This investor awareness event of 8th event and 32nd event of Aditya Birla Sun Life Mutual Fund with Hindustan Times is happening around the time the industry is celebrating 50 lakh crore size of Indian mutual fund industry. And this exercise of us started way back in 2012. I'm happy to stand in front of all of you to mention about the contribution that Aditya Birla Sun Life Mutual Fund have been doing in improving the financial literacy in the country, along growing the our own assets under management, which is close to about 3 lakh 30,000 crores. This is something that makes me feel proud. So I also want to take this opportunity to thank every participants who would either be an investor with us or who would become an investor with us in the future in many ways, and also our distribution partners who have been working for the industry tirelessly in growing the size. And of course, other stakeholders who have also been, including the regulators, who have been the guiding force in making the industry to become larger and larger. So in today's topic, of course, once again, is around the investor education, absolutely no doubt. And today, the SAP way of investing has now become the way of investing, whether you are rich, whether you are poor, whether you are middle class income person, whether you are salary class person, whether you are self-employed person, or even actually HNIs investors. All of them actually today prefer to invest through the SAP or STP, given the fact that India as a country emerging to be the most powerful country in the world with the rising GDP, with the rising economic growth by way of creating a policies that are more inclusive in nature. And among the world economy, India is becoming the economy to look for, not just only for the year 2024, even beyond that for next 10 years or 15 years. And that is being the case, we as an Indian, too, we should participate in creating wealth for ourselves to meet the future needs by way of investing in mutual funds. That is becoming now is a must. I'm happy to even mention that 50 lakh crore of industry today we are managing. It's happening on the 30th year of Aditya Mutual Fund existence. We as a mutual fund have completed 30 years have been in the industry. Of course, more of coincidence that I am also part of the same firm for the last 30 years, and 32 years I have spent in the mutual industry. In fact, if you have to look at the journey of the last 30 years, the first 10 years would have grown at a snail's pace. The next 10 years would have gone a little higher than a snail's pace. The last 10 years, the growth has been faster than the last 20 years. My own assumption is the next 10 years, the growth will be much faster than the last 30 years. What will enable this? Increased awareness, increased need that comes in from every household's point of view. Therefore, these two things I think will make it grow faster. The second is digital penetration in India has been quite aggressive. Today, every household, whether they know to read or write, but they're able to handle mobile phone for transaction point of view have been rising. I think we at Aditya Mutual Fund have been emphasizing the importance of using technology by way of using your app, and many other such facilities have been created for the purpose of investing. Therefore, each of the participants, they should not only, of course, grow their investments into the mutual funds as one of the primary vehicle. Because all of us use one as a primary vehicle for savings. One, of course, primary vehicle is our own bank account, no doubt. The second primary vehicle, we use it as a gold. Third, we use it as a real estate. And fourth, we may probably use it as a FD. And fifth, we may use it as a mutual funds. And then sixth, we may use it as an insurance product and so on and so forth. My own belief is the primary vehicle for managing the individual wealth should become the mutual fund vehicle, which essentially means it gives you all the facilities such as a bank, like withdrawal at any time, like it can be saved anytime for any purposes, and except that it is linked to the market in terms of fluctuations. I'm happy that today's session is lined up with many speakers who will not only give deep insight on investing as a world, they'll also give you some advice on behavioral part. I think what is most important is the behavioral part is very important when it comes to the question of investing. Second is the discipline that one has to be maintained irrespective of all the ups and downs that one may have. What makes the successful in the long run is a discipline. I'm sure the sessions that's going to be conducted in this Nivesh Mahakumbh event of 8th event with the Hindustan Times is going to cover the entire aspects of investment, including influencing the decisions and doing good for yourself by being early, by driving slowly and reaching the destination safely. My own colleague, Mr. K.S. Rao, who is head of the investor education program for Aditya Mutual Fund, he has been driving this tirelessly for the last 10 years in reaching out to every possible manner in the country, which I call it as the Bharat as a country. Every location has been reaching out with the help of very strong reach, which the media partners have got, like Hindustan Times. They have a huge reach serving the need of the people in the country. I'm sure people of that kind getting involved, this session will make each one of you more richer in terms of knowledge and improve your understanding of the power of investing. But unless until one is a qualified mutual fund distributor or a qualified registered investment advisors or an informed investors who have gone through a cycles of investing, but otherwise all of us as a common person can only share the experience to others of goodness that we have done, or maybe the good that we got. Therefore, it benefits the whole ecosystems. So I wish the conference a grand success. I'm also hoping that the conference, the topic of discussions and deliberations would add a significant value to each one of you in creating a wealth for yourself. therefore derive happiness of investing in the Indian equity market. So I'm sure Bharat as a country will progress quite significantly. Therefore, it is important for us to participate in this growth journey of India, not just for 1 year, 2024, for next 10 years, even beyond that. And thank you and wish the conference all the best.
Thank you so much, Bala. And indeed, it's been such a fantastic growth journey for India, for Bharat, because when we look at it, the first 10 lakh crore assets under management, it took more than 50 years, almost 50 years. But when we look at the journey from 40 lakh crore to 50 lakh crore, which was reached in December 2023, it's been just a little over a year. So the growth story, well, we have just scratched the surface. And time now to move on in the agenda. Before we begin our first panel discussion, let me also take this opportunity to announce a first of its kind initiative in the mutual fund industry by Aditya Birla Sun Life AMC Limited. It's called Fingo MF. It's a unique simulation-based investment gaming platform. Now, this is a special New Year's gift for new age investors, especially Gen Y and Z. So embark on a journey to achieve financial goals, experiencing different market cycles, and making decisions that impart valuable lessons. It's got it all. This interactive game not only enhances financial knowledge, but also rewards players with intriguing questions. Are you curious to know more? Well, let's welcome Mr. K.S. Rao, who is the Head of Investor Education and Distribution Development at Aditya Birla Sun Life AMC Limited, to shed light on the novel platform and also formally launch it at the Nivesh Mahakumbh Forum. Good morning, Mr. Rao. It's over to you.
Good morning, Gautam. Thank you so much. And good morning to everyone here. And wishing you all a wonderful new year 2024, though we are on 20 days past, but still lot to left. And every year we start our year with the Hindustan Times, with the Gautam around. It is on reflections and resolutions, reflections of what happened last year and resolutions what we intend to take for the current year. Of course, we have a lot to go on the day, but I'll before I have a pleasure here, I have a great pleasure, and with enthusiasm, I can say it's as Gautam said, it's a groundbreaking gamification platform which is designed to promote financial literacy. And as you all aware, we are embarked on this mission of financial education over last 1 decade. I mean, just now Mr. Bala spoke about the initiatives which we do across, and we sincerely thank our partner Hindustan Times for our association in this journey. And it's 8th Nivesh Mahakumbh here. And this gamification platform is a great opportunity for us to launch it today. It's the most auspicious we consider. And this gamification platform is, we are we have a lot of content available for the traditional way to do. And on our website, www.mutualfunds.adityabirla.capital.com, you have everything about investor education and investments. And this gamification platform, we technically put it especially for our younger generation. In fact, later one panel we have how the millennials can look at money. We can do this, and it is helping them to it's captivating the nature of the gamification and the combination of the financial education. And education should not become boring, and education should become exciting. This is where we have one initiative with Hindustan Times called Friday Finance. It is all about the youth, how they can manage their money. And here the gamification platform which is coming, which is accessible to all of you after this, and we will be launching in a while, and which is going to it's an integrated financial education with a lot of games, quizzes, and which you can learn. There is a huge opportunity through this platform, and it's our commitment, our steadfast dedication for the financial education. We always try to innovate something. This is first of its kind, and we intend to work very closely. And of course, this is the first platform of the gamification, and there will be a lot many to come. And here in the gamification, it can help everyone who is working with it. For one is to accomplish your financial goals, stimulate learnings, and stimulate your investing, and how you can look at. I request Hindustan Times team, HT Digital Media, to please inaugurate this platform for our audience. I invite all of you to try your hands on this, and thank you for your attention. And we invite you to join this transformative initiative, which is embarking with an exciting journey for promoting financial literacy through the power of gamification. And gamification ultimately leading to accomplish your goals. And for me, the gamification is something, it's I call life, living in financial empowerment. And when it comes to a game, you have a lot of fun. For me, that game is an acronym. I mean, I call it as you have a goal, you have an aspiration, and you need to get that manifestation. And later you create that experience. Let this gamification can work for you. Let it be more engaging, let it be more enjoyable, and let it be more effective. And over to HT Media team to launch this. Thank you so much for your attention.
Imagine playing a game that not only entertains but also educates you about smart investing. Well, now you can. Introducing Fingo MF, a unique simulation-based investment gaming platform by Aditya Birla Sun Life Mutual Fund. Whether it is accumulating a retirement corpus, planning for an exotic vacation, thinking of a higher education overseas, it's important to plan for every stage of life, and that's where this game comes in. It takes you through that investing journey in various asset classes with respect to different risk profiles. What makes it fun and unique? Plan in a gamified way. Select from 4 strategic goals. Build long-term wealth. Invest for early retirement. Plan for major purchase. Save for kids' education. Play quizzes to test your knowledge. Engaging questions to boost your financial knowledge. Scan the QR code to get started.
An investor education and awareness initiative of Aditya Birla Sun Life Mutual Fund. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Well, Mr. Rao, it truly looks very interesting, and I love the acronym that you put out for LIFE, which is Living and Learning in Financial Empowerment. And in fact, that is going to be the theme of our first discussion, which is empowering the future and providing insights to young investors for 2023. But talking about this new platform, it is an exciting new age platform for our investors and definitely looks quite interesting. Mr. Rao, I'd request you to stay back for our first panel, though, and we will be talking about empowering investors. But in the meanwhile, let me also introduce you to our co-panelists. We are joined by Appala Sai Kiran, who's the founder of the Scope app, and Harsh Goela, who's the co-founder of the Goela School of Finance. Thank you, gentlemen, for taking time out from your busy schedule and joining us. We will begin this discussion shortly. As I mentioned, the topic of our discussion is empowering the future, insights for young investors from 2023. Stay tuned for that. Well, as I mentioned in the first riveting panel discussion of Nivesh Mahakumbh 2024, we will delve into empowering the future and provide insights for young investors from 2023. Let me set the context, though. Navigating this complex realm of personal finance, especially for the younger generation, that demands insights, strategies, and a forward-looking mindset. Now, in the wake of 2023, a year marked by challenges and opportunities, the first panel discussion here at Nivesh Mahakumbh 2024 stands to offer a compass for young investors. Now, as we reflect on the lessons of the past and peer into the financial landscape of the future, this discussion will unravel the significance of early investing, the integration of technology, adaptive strategies in the face of uncertainties, and of course, the mindful planning required for early wealth building. I hark back to what Bala had mentioned earlier. It's not just about the strategies, it's also about the behavior that we look at encouraging from investors. So let's begin this panel discussion. Mr. Rao, I'll start with you because in the landscape of financial education, I want to understand from you, how do you see the role of investor education evolving, particularly in addressing the needs and preferences of the younger generation?
Thanks, Gautam, once again. Thank you so much. And indeed, it's an honor to be with the panel, the young boys. I mean, Sai and Harsh. I had a privilege to spend some time with Sai in Delhi, and I heard a lot about Harsh's programs and the education, the school they run. And glad to be this part. And good, we start our journey or this panel today at Nivesh Mahakumbh, starting about the next generation, the young generation. And incidentally, the numbers were like mind-boggling today. It's like 34% of the population, I mean, are roughly around 440 million, or the youngsters who we call millennials. And if I can add Gen Z today, it is a 52% of the population. And with these numbers, and over last few years, how the mutual fund industry has got them. I mean, we have little over 8.4 million people, I mean, million young investors who have joined in the mutual fund industry in the last 1 year. And coming back to your question, Gautam, and the role, the pivotal role the investor education plays, probably that is the most important part, because this generation, when they learn right, when they start right, then they can take a right investment decisions. It will help them to navigate the complexity of the investment world. It will take them to take an informed financial decisions. It will also help them to align their values and goals. Because this generation, I have seen most of the times, it's like they have their own value system and they need to adapt to those value system. And I believe the foundation to be done, unfortunately, in the formal education, we do not have in the school the financial literacy. Probably for the youth, we need to make that foundation, how that strong foundation we can create at this point. And incidentally, national educational policy, which is started, which is embarking now, which is incorporating the financial education part of the curriculum. Now today we work very closely with the CBSE, and I'll share that little later on a couple of our initiatives, how we do with the CBSE. And this the financial literacy will help the generation to take the right decisions. And taking the right decision is to taking the managing the risk. I mean, sometimes you ask any parent. I mean, they look at their children who are especially millennials. No, my boy, I mean, he's ready to, or my this girl will take a lot of risk. And sometimes there is also like parents will guide them not to take risk, and both are not right, and taking the right investment decisions, right, which can be long. And I call, today we are on a platform. I mean, some of us who use iPhone, we have this platform system in which we call iOS. Probably for this generation, the iOS is, they have a very much, they have so many investment options, and they have strategies how they can navigate, how they can be successful. And generation is very tech savvy, and how the technological advancements can make them available, and which is including those digital tools, the platforms. Probably today you can see some of those platforms helped them to come. During pandemic, I could see one third of every third investor who had come to mutual fund is from these are the millennials, these are the young generation. It's a, I mean, it's almost every third application is the next gen people who are there with us. And for them, there is another my interaction with the youth is like, I do this program called My First Paycheck. And that a very young generation, they look at sustainability of investment, they talk about sustainability of the planet. And I talk to them, you are very good at understanding today and sustainable and social responsibility. And I tell that, that SRI, social responsible investment, but you need to have SIRI, that is Siri. We call in Sanskrit it is, or it's not the iPhone Siri I am talking about, Goddess Lakshmi Siri. That Siri can come to you when you have a sustainable investment and you have a regular investment. How you can get embarked on that, whatever the goals you have. And last but not the least, the financial literacy helps them. We have seen, I mean, I'm nothing against crypto, but the way people have fallen victim, especially in Indian context, and why you should not take any investment decisions which are not regulated in the country of origin where you are residing. And the last one, when you spoke about earlier, Bala spoke about, is financial education helps them to mold their behavioral part, and the behavioral finance is the most important part. And behavioral finance and emotional intelligence together will form a part. Why I talk emotional intelligence is sometimes the old time and the investors like me who will be taking decisions little more understanding, not to take any decisions, or like today the technology plays a two ways. One, my investing is become much more easier, but disinvesting is also become easier. If I have read one news item of yesterday's war, something to go and happen tomorrow, predict, and I will disinvest. Probably this is where investor education helps. Last but not the least, I think they should get a good financial coach for it. I think this is what I look at. roles of investor education and the needs and preferences of their education will change. Of course, we can learn a lot. I heard both of them, and I had a lot of interaction with Sai. I'm sure it is going to be, this platform belongs to them.
Absolutely. And I'm looking forward to hearing Sai and Harsh, of course, detail out how the route ahead looks like. But a lot of important points that you've shared, Mr. Rao, which is food for thought for viewers who are watching, because while the markets gyrate, one day you will see a 1200 point drop, the next day you will see a 600 point rise. The idea is that you should be educated about your investments so that you can stay the course and make sure your investments are working towards achieving your life goals, because at the end of the day we want to live life to the fullest extent, and for that you need money. And if you have invested in the right way and if you have stayed the course, you will have that fuel to take your life to the next level. So let's get our inspiring individuals to comment on this. Sai, I've heard a lot about Scope. It does wonderful work, especially as a connecting platform, mostly for underrepresented folks, for underrepresented founders. Now, I want to hear from you how you perceive the challenges that young investors face in embracing early investing, and what solutions or guidance does Scope provide to address these challenges?
Well, in terms of young investors, I'm more of the private equity guy, so I'm not going to talk about the whole public market. But yeah, there are some certain similarities when you come. So first of all is dealing with the FOMO attitude when it comes to young investors. Now, let's say people who are stepping into the market and they have wide array of options to invest in, and they have a lot of people telling a lot of stuff about the best investment opportunities, and how to multiply 5x 10x their money. And the thing that I find is the lack of understanding of these investment strategies before put in money. So as I was when I caught up with KS Rao sir in Delhi, we were having a similar interaction point. What is the biggest challenge that young investors find? It's kind of misunderstanding or misappropriation of these investment strategies that they see on social medias from fin influencers. That's kind of the biggest troublesome point, because what many of the youngsters see is how to get quickly rich, or how to get quickly 10x their money, 5x their money. But it really doesn't work that way. That understanding needs to be made in a very somebody who is influential, or who is in the field for a very long time. I guess when they say it, I guess that understanding becomes much more impactful to the younger generation. That's one thing. But in terms of how Scope is trying to help over here, is more of the community that we are trying to provide to the younger investors. The problem is when younger investors come into this and they're alone in their journey, it's kind of tough to navigate these waters because there are a lot of things. But when you have a community that you can work with, that you can ask questions, that you don't mind making mistakes in front of, I guess it makes the journey a bit easier. It doesn't make it a whole lot easier, but it definitely makes it a bit easier. And especially Scope definitely tries to promote the long-term perspective of investing. There is no short-term gains. So the whole crypto thing that has happened in the past years, that has kind of made a wrong image about investing, that quick investing, short-term gains, and multiplying your money. But we try to promote the long-term investing perspective, and see how do you do risk management. Behavioral finance is also definitely, as K.S. Rao sir said, behavioral finance is definitely one of the most important things that the young investors need to be educated about, and that's what we try to promote a lot.
Absolutely. As the quote goes, if you want to walk fast, you walk alone. If you want to walk far, you walk together. So the support of the community especially is essential, especially when the tendency for short-term thinking arises, right? Everyone wants to make short-term gains and then retire early, but there is a certain method to how you make money, and it's not always to take risk disproportionately. And the understanding of risk is key to ensure that you achieve your financial goals. On that note, Harsh, let me come to you to get your thoughts on how young professionals can strike a balance between risk and return in their investment strategies? And what role does mindful financial planning play in achieving this equilibrium?
Okay, here I would actually agree with what Mr. Rao said and what Sai said. Is that first, to achieve that risk reward ratio, we need to understand that trading is not the answer for 99% of the people. So, how I think that how youngsters, in my experience, perceive stock markets is that they get attracted to stock markets by the glamour and the glitter that surrounds it, right? That you will get rich in 3 months, and I completely agree with Sai that there are some people on the internet that show that I've got fancy cars, this, and a day is gone and
You've
you're
got
earning
quotes
lakhs a
as
day.
well, as they say, risk hai to ishq hai.
Ishq hai. Yes, 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 yes. So I think this is one part that definitely needs to improve, which I am sure it's actually improving. People are realizing the ground reality, and the main thing that everyone should take the risk that they can handle. A lot of people don't understand it. A lot of people are taking money on margin. They are taking money, lending money, and then going for fusion options, wherein you need big pockets for that. So for me, the answer lies same, that you invest in good quality companies and you invest long. This is how the biggest investors have made money in stock markets. This is how the most successful people have made money in stock markets, and this is the way it is actually should be. So you invest in small affordable amounts, you invest for long term, and you invest in good fundamentally strong businesses. And I think that is the thing that hits your risk equilibrium. How I design my portfolio, I'm a huge football fan, so I will have a ideal portfolio of 11 stocks, wherein I'll have four stocks that are very safe sectors, secular sectors like FMCG, like pharmaceuticals, that are consistent compounders. Then the strikers, the stocks that will be at the helm, one or two stocks, they will be a little more at the riskier end. Like if you talk about sectors like renewable energy, now a lot of companies have high debt in that specific area, but it is a sector that can give you extremely high returns in the near term future if things go accordingly. So this is how one should balance the entire portfolio. But yes, having consistent compounders in there and investing in the index is a must to have that risk reward equilibrium.
Absolutely. It's a good visual mnemonic that you provide when we look at
Right.
investments as a football team, right? Because you have your
Yeah.
strikers, you have your midfield, and you have your
Yes.
defense. So you make sure that you have a fully fledged team working for your benefit. On that note, let me come back to you, Mr. Rao, for extending some of the talking points that you mentioned earlier. Because considering the current economic climate, what strategies would you recommend for young investors to enhance their financial literacy and make informed investment decisions? Because it's easy, as Harsh mentioned, to go with the herd mentality. You hear about options trading and you see that, oh, some people are making money 3x, 4x, 5x in a day, maybe I should go. And then you go and have your margin problem, margin calls happening. Your thoughts on how the young viewers, the young investors should actually enhance their financial literacy?
Yeah, thanks, Gautam. I think interesting conversations from both of them, Mr. Sai and Harsh. I mean, amazing. And I love that anecdote of football. I mean, as a team, when you need, I mean, there's a goal. Probably football, it's the biggest thing is we have a goal post, and that's where you need to reach. And you have a multiple players, and this is where the diversification. And you have a goal post. You have a goal post, and you need a diversification. Probably your biggest friend in accomplishing is, for me, mutual fund is a mutual friend and can help you, because the diversification happens in very auto mode, and that can take you to a different level of game where you can look at, as I said earlier, investment options and strategies. This is like your iOS platform, your iPhone operating system. You need to upgrade yourself every time. I mean, it's not that what you have learned today will be ever, but probably the some of the fundamentals what you learn is the most important. Probably, I mean, there was no formal education on the financial literacy. Probably you can get to those informal education, get your right mentorship and get into the right guidance, and have that simulating investing experience. That is where we said today we have a gamification platform which we have found for youngsters. I can only say, this is the learnings which I got from my first boss when I joined the job. He looked at me and said, when you are going to retire. I was looking at this guy, this man I joined today, and he's asking me about my retirement. And it's such a visionary boss I had. And he said, how you start saving today? And that is a time when, it was the government of India's job, and you have this 10% of the provident fund. And he was asking me to put your 10% is going to your PF. Can you save another 10% and rest of the night 80% you have a joy to spend? And this is where I learned you need to look for your long term when you have started your career. Look at the retirement, but it's not like the previous generation which is retiring at the superannuation stage. This generation will retire at a multiple stages of life. Either you change yourself or your career change or your company changes. Means there is a breaks which you take. How you are planning for this? Means I look at you need to have the financial goal. Retirement planning is a part of the life, but retirement planning, then you have a learning goals. You need to. Day before yesterday I was talking to a few of the IT guys, and this is one function fully going to redundant, and they have given an option in the next 6 months they need to upgrade, and they need to get into the new platform. And that is where you need to put the time for the learning. That is where you need to look at your financial well-being as a long one. And like today we are living in artificial intelligence. We talk about chat GPT. I was telling this generation of the youngsters at IT company, you got your own for investments, your own chart GPT. I said that GPT for me is your goals, your plans, and your travers. And all that what you need to look at, how the country is looking at, and all that you need to look at, you are at a wonderful time of in India where, we talk about Amrit Kal of the India's investment. And this is the time the country is going to prosper. And while you look at inspired with the GDP, which is growing consistently, yesterday I was listening to our economic secretary, Mr. Anant Nageshwaran. He is talking about this year when I think on February 1st, January 31st, he is going to have the survey financial. I mean, it's going to be 7% kind of it. And next 2 years, we are looking at 6.5 to 7%. And good GDP is looking good. And I was talking to these youngsters, country's GDP is looking good. But how about your GDP, what you are looking at? I said, your GDP is your own goals and disciplines of staying with that goals, and also have a patience to live and how you can invest. Probably, I mean, when Sai Kiran spoke about PE and the youngsters, and when investment in the stocks, when Harsh is talking about, probably you can have this excitement. And I love this study done by Mr. Nitin Kamath, as he spoke about earlier. This is SEBI has done this study, of course. I mean, 87% of the people who are investing, who are excited with the trading and started trading, have not made money, but they have made losses. For youth, I can look at is keep this excitement with a part of the money as a learning. It is a simulating experience, but 90% of your money can be go into your places where you can feel, you can create your financial ability, financial well-being better. Means the strategy you need to adapt is long term. Strategy you need to adapt is starting early. Strategy you need to adapt is income what you get today. It's can you have an option to spend more, you have an option to save less. How you can look at my old when I started my career, my first boss told me income minus expenditure is equal to his savings, and that is the time I minus E is equal to S. That was easier. Today I minus E is equal to S is very difficult. Only thing you need to change that platform, that formula. I minus S is equal to E. Income minus savings is equal to your expense, and that savings how you can convert into an investment, how that investments can convert into your invest according to the financial goals. All that secure about the present and plan for your future and look for your financial goals. I think Warren Buffett who said it's like wealth does not come from your income. Wealth will come from your investments. Ensure that investments create a wealth. And I love there is I don't know we have enough time to decode these two individuals, and especially my interaction with Mr. Sai. And at this age of time, how matured he is and how much of wealth he created, not only for himself, for his investors as well for his employees. This is a generation.
Absolutely.
I mean, we can't underestimate this generation. They have amazing potential. All that they need is they need to get directed. I mean, they spend most of the times in OTT platforms, but OTT to other platform is for how they can make their life better. And they spend most of the times in a gym and the physical fitness. Probably they can move from the physical fitness to the physical fitness. All that strategy what they can adapt is financial management with the right risk management.
Absolutely. As it is with physical fitness, when it comes to fiscal fitness, the goals, the discipline, and the patience can also work to the benefit of our of all investors. But specifically speaking on young investors, that as Mr. Rao mentioned, Sai, coming to you, there is the professional side of things where folks are very, they're razor sharp in terms of achieving their goals. The issue is sometimes when it comes to your personal life or investments to work for you, there's a passive approach to personal life investing. So in your experience, Sai, what mindset shifts are essential for young professionals entering the world of investing, especially considering the uncertainties of the financial markets? Because everyone wants to retire early, but they forget that there is a certain amount of patience required. You shouldn't time the market, but you should rather spend time in the market. So how do you achieve that mindset shift, Sai?
So achieving that mindset shift, as you said, many of the people want to go NASCAR driving before they even learn how to control the pedal, accelerator, and brake. Before they even learn that, they want to go NASCAR driving full speed ahead with their investment strategies. So I guess that is the wrong approach. And as I mentioned earlier, that's kind of been the social media. And I always say social media explains only half of the story. Other half is hidden. And the mindset shift will generally come across, when the established players of the market are educating and spreading the information more. Because as much as we see the glory, it's not just investing, as much as we see the glory in each and every field. In terms of startup also, many people see the unicorn status, the glamorous lives on social medias, but that isn't really not many people see, how many hours of sleep is lost over there, how much stress the person has been taking, how much time he has been, spending on fundraising, paying employee salaries. There are a lot of stuff. There are a lot of components that come out there. So there are similar amount of components that come into investing capital, and trying to. So I guess the first of all, the younger generation needs to see that, before making 2x or 3x, first they need to focus on, let's try to minimize the losses in the first investing. Okay, I'm not going to ask anyone to generate a profit, but how can I not lose a lot of money first? If you're able to minimalize your losses, I guess then you're setting up your ground. Once you're setting up the ground, then let's talk about 2x returns, profits, portfolio, diversifying your portfolio and everything. But that comes at a later stage. Okay. And I guess it's more about the awareness and more about, how these person now, as KS Rao sir was saying right now, many of the youngsters or many of the uh, people in the investing landscape now, idolize Kamath brothers a lot. They look up to them. They, see what are they doing, how are they investing, and everything. Now, when such personalities speak about, how exactly investing happens, or how their journey has been, people draw inspiration. People understand the ground realities. Okay, it's not as glamorous as, I'm driving a G-Wagon, I'm driving, I'm going across the city. It's not that. So I guess it's more about the awareness. It's more about the ground reality. It's more about, not focusing on the profit initially, but try to minimize your losses first.
Those are some great points.
Yeah, if you're able to control your losses, you are, stepping initially into the investing landscape. And
I guess you could say it's about managing expectations and managing choices in life, right?
Absolutely.
All right. Taking that forward, Harsh, let me bring you in because the Goyal School of Finance that emphasizes mindful financial planning. So, in this context of managing expectations and managing choice, what are the key investment choices that individuals can make when we look at, let's say, because the obvious motivators would be reducing taxable income and accelerating sort of early wealth building. So, from the lens of tax and early wealth building, how can investment choices be tweaked?
Interesting. See, for me, when I entered stock market in 2010, right, and we all of us have heard that trading is very risky and stock market is very glamorous from outside. But I feel it's a very human thing to get attracted to trading first. When I entered stock markets, I entered because I wanted to double my money in a day or two. That was the sole purpose when I entered. I think most of the viewers watching this would have that same attraction. It's only with time that you realize that if you're a good trader, you will not be a trader for long, because the real money is in investment, and that is how you actually make it. And trust me, I've never seen any trader in my life who I know personally who's been profitable or at least beating the index for a consistent period of 3 years. I have seen none. I have seen people finishing before it. And to adding to what Mr. Rao said about the SEBI report, I think about 90% of the traders are not profitable in FNO. And this is, I don't have any quantitative data to back this up, but according to my experience, the 10% traders who are profitable, 80% of them are not even beating the returns of the index. So, first thing one needs to realize is that it will take time for you to understand investment, and you need to have a maturity to understand that there is some immaturity when you enter stock markets, irrespective of whatever age you enter, irrespective of however much experience you have. I think this is one journey that everyone goes through. And s- what I quote people is that since 2020, I think most of the viewers would be active in stock markets since 2020. Look at, since 2020, where has the index outperformed? And if they are trading, they can see their trading portfolio or see others, people around them, not specifically on the internet, to see have they beaten the index for the past 3 years, past 3 4 years. And I think majority of the cases the answer would be clear no. So this, I feel, should bring a great, it should light a bulb in all of us that investing is the real answer. So when we talk about mindful investing, the key, the basics are the same. You invest in a good business, that business that you understand. Like we all see Shark Tank, right? When a How I approach stock market is that all of us are sharks, and the stocks presented to us are like companies, right? And we need to ask them questions. What is your ROI? What is the industry? What is the scope? And when we are seek Shark Tank, we see, okay, I think this company will do well. You should have invested here. The same approach, the basic approach, needs to be taken in stock markets. The most stock markets can be, your investments can be as simple as you want them to be, and at the same time they can be as complicated as they want them to be. The key is same. You read any great investor, is to invest in good businesses. That is the only key. And yeah, and I think if one is doing this, so the probability is extremely high that things will turn out very well from him, seeing the current scenario of what India has and how lucky we are to see this growth of a country. So yeah.
Absolutely. The amount of time we spend in trying to select a phone to buy, right? If we spend that same amount of time in looking at investment options, when we look at mutual funds, whether it's
I
index
think even
funds,
one
whether
third
it's
amount of that
actively
time would
managed
do that
funds.
trick. Yes.
Fair point. Point taken. Mr. Rao, coming to you, especially on this point of we are in a very interconnected world. And of course, everyone needs to be more aware of the investment options which are available. As we mentioned, 50,000 crore AUM has been crossed. So the investment universe has also rapidly expanded. So, Mr. Rao, how can technology be effectively leveraged in investor education, and what initiatives is Aditya Birla Sun Life AMC taking to bridge that financial knowledge gap?
Yeah. First of all, I'm very energized with the two young speakers around and the knowledge they carry and the maturity they carry. And thanks, Gautam, for having them as a panelist here, and it was very interesting. And invest education probably, from first of all, from my fund house, and also I talk about the Mutual Fund Association. AMFI has done a lot on the mutual fund, on the invest education over a period of time. And technology is definitely playing a very, very vital role today. And incidentally, post pandemic, the everything what we do is either on the digital platforms. Now we have started the gamification platform. And invest education from my fund house, for the youth, I would like to start with. We work today with little over 30 universities, which is a program called, it's a workshop. It's called My First Paycheck, and this My First Paycheck is for the final year grads. You are moving from the earning stage to the learning stage, how you need to manage your finances. And we have quite a good amount of content available on our website on the digital side. And every week we do a digital initiative which is called Investor Hangout, and people can learn what's happening and what you can do it. I think earlier Mr. Harsh was talking about how the trading, how you can get excited. It is not the question of exciting, it's a question of getting yourself educated. And this is where we are putting that, how you can look at. We talk about when I go to these corporates and we do a lot of fiscal fitness workshops, and the first question I ask them is, many of you know your KPIs, and that's your key performance indicators. And for you, for when it comes to investment, the KPI is, first of all, know yourself. That is, earlier when football we are talking about your goal post, your GPS, where you intend to travel. And the second one, if you know your goal post, what kind of plan you intend to do, what is that, how you intend to reach, what kind of, it is like, it's not exactly, my generation talks about 3 or 4 goals. It is a retirement, and it is about your children education, or it's about your house, or it's about your travel. For this generation, there are multiple things. When I go to the schools and college, especially colleges, even there today, I have seen some of the students, they have a mobile replacement fund, which they intend to change their mobile every couple of years. Probably they create some fund for it. It's a part of the pocket money is diverted there. It's a time for them to get there. And the last one is, when you have that KPI, your know yourself, your plan, and how you invest for it. And you have a multiple investment strategies. Sometimes certain things excites you. I mean, maybe a small case excite you. Sometimes an index fund, sometimes an ETF. Probably have your own one mutual fund portfolio simultaneously, because this will help you to stabilize. Because other things, when market is highly volatile, then something you need to stabilize. And today everything looks good. I mean, we are talking everything positive. I mean, indices are looking good. India's GDP is at 4 trillion. But but there are also headwinds we can face. It could be the war, it could be something else. Can you overcome that? Have you kept your emergency fund ready for you? And the last is, all our digital platforms are only uh, helping the people to get their investments right. And each of these dish, I have a podcast to everything available to them. It's like, on the learning you can go. Today's Fingo is a financial investment on the go, financial games on the go. You can learn. These are the various initiatives we do. In fact, we run one personal finance magazine called Samruddhi, which is goes into the Vande Bharat trains, and we are looking at Amrit Kal of the Bharat, and this is an education platform.
Absolutely. Financial literacy available anywhere, anytime. But an important point as we head to the final leg of this discussion is also the platforms that people are using. And Sai, let me come to you for that, because the fintech landscape that is rapidly evolving. So to get your perspective on how young investors can effectively navigate and leverage fintech platforms for their investment journey, because the tools are available for everyone for any use case that they might have. How do they navigate that terrain?
So I guess firstly, you got to understand the use cases of every platform. Okay, every platform has a particular use case. You got to understand it, and you got to be aware and educated about these platforms and the compliances, basically. And let me come to the lending aspect first. Okay, in the lending aspect, you see a lot of apps, are lending amounts to to the daily Indian consumers. The problem in such apps or platforms is that they might not be regulated, or they might not be compliant, and taking a loan from them, from such platforms, is a very risky thing, because we have heard stories, we have seen cases where the people who have taken loans have been facing what do you say, various challenges in terms of repayment, or in terms of their own what do you say, threats or any blackmailing kind of things. But you need to be aware and educated about those platforms and the compliances they are. Just use use the platforms which are compliant. Okay, be educated about the platforms you use. Money is incentivizing, but take it from the right source. Okay, so that's one thing that we need to be aware of. And definitely the trends and tech trends that are happening in the fintech spaces, you got to be aware of, because SEBI is coming up with new rules and regulations every now and then. So you got to be aware of those rules and regulations, because that really impacts fintech players a lot. So let's say any of the regulations are impacting any one of the fintech players that you are using on a daily basis, you got to be aware of it. So I guess being more educated about these platforms compliances, their use cases, and how the day-to-day laws are impacting it is going to be the best way to navigate through this fintech landscape. And just the thing is, like a lot of a lot of veterans in this profession have, also trying to cope up with the whole FOMO thing. It's not easy to escape the fear of missing out, but I guess it would be best to consult people when you don't know stuff. When you don't know stuff, it's
Indeed.
fine to ask. So that's the best thing I feel. You gotta be able to take advices when it's from the right person. So that's, I guess.
That's a very, very important point that you mentioned, Sai. If you do not know, ask. That's a very important part. Do not navigate alone. And Mr. Rao, as you mentioned earlier, this new generation is wise beyond their years. So it's great to see that they already have a head start in knowing, more importantly, what their goals are and then framing their investments accordingly. Harsh, let me come to you for your thoughts on the learnings from 2023. What adaptive strategies would you recommend for young professionals to enhance their financial resilience?
Uh, See, for me, I think the biggest learnings takeaways from 2023 that I would want anyone to take away is again the point that I mentioned earlier is to see how many traders have actually beaten the index for the past 3 years. If you haven't, then go long. So for me, trying out into these different ventures, it's fine. And like I mentioned, right, it's very difficult to escape FOMO. And because there's a lot of noise around you, there was a heavy buzz around NFTs earlier, cryptocurrency earlier, and now some specific stocks that have really done well. There's a heavy buzz around them. So it's difficult to avoid FOMO. I completely agree to it. So for me, the best things would be this year that first one should follow content creators, finance content creators who are giving you more research oriented things. And that I think it's very clear on the face of it because I feel finance content creators have democratized stock markets for everyone, which is a big thing. And the massive participation we are seeing in stock markets. I don't have any quantitative data to back it up, but for me, finance content creators have had a major role to play in it. And yes, there are some bad fishes in every pond, so that's given. So first thing is follow the right people. Second is that get into the habit of researching bit yourself because nobody else is going to make money for you until the point you understand what a mutual fund is holding, what stocks a mutual fund is holding, or what the business does that stock do. You will never have that conviction to hold long term because it's easier said than done, right? It's very easy to say hold long term, but when it's your hard earned money, there are points that you stop believing in God also, right? If the markets takes you in such a rush that you don't know what to do, you don't know how to act, and behavioral economics comes into picture, behavioral finance comes into picture, so all those things. So my thing would be that to invest in good quality businesses. You are thinking 3 years might be a long time, but look at 2020. Look, we are sitting in 2024. It's gone like this, and the coming 5 years, it'll even keep going faster. So please, if start investment first in good quality businesses, understand those businesses, have developed some capability to do research on your end, some capability, so that you know what you're getting into and you can have some sort of resilience. And afterwards, you want to have a small portfolio where you want to experiment trading or you want to just keep things exciting, you can, because investment is boring, undoubtedly. And I know a lot of people who have those 2-3% portfolio where they just keep on playing with stocks just to keep things exciting for themselves. So, and if investment is getting boring for you, I think you are at the right end. You're doing things the right way.
That's a good message. If investing is boring, then you are on the right track. And it's been a wonderful conversation between Mr. Rao, Sai, and Harsh, especially on empowering the future for our young investors. As we discussed, you need time on your side to make sure that your investment is working for your benefit. Stop chasing the short term and look at the long term to enhance your life. And those have just been some of the insights for young investors from 2023, and we are looking forward to 2024 again being a productive and fruitful year. Thank you so much, gentlemen, for joining us and sharing with us your insights and perspectives on this topic.
Thank you so much. Thanks.
Thank you.
Thank you, everyone.
Thank you.
And to our viewers, it's time now to move on to the next item on our agenda, which is a fireside chat with Mahesh Patil. Stay tuned for that. Well, from a panel discussion on empowering the future and gaining insights from 2023 for our young investors, we are now moving on to a special fireside chat with Mahesh Patil, Chief Investment Officer at Aditya Birla Sun Life AMC Limited. Now, to tell more about Mahesh, he has over 30 years of rich experience in fund and investment management, and he leads the entire investment team, which comprises fund managers and analysts at Aditya Birla Sun Life AMC Limited. Mahesh, thank you so much for joining us today, and looking forward to your expertise, because when we look at 2024, it's already seen a few events happening. So, to start things off, in the ever evolving landscape of financial markets, what key trends do you anticipate shaping the investment scenario in 2024, and how can investors position themselves to leverage these trends? Let's have your thoughts on Nivesh Mahakumbh 2024 on this fireside chat.
Thank you, Gautam, and wish all our viewers here happy New Year. Okay, so just to look at last year was a pretty eventful year, right? I mean, nobody thought that the markets could do well, right? On the back of various challenges, what we saw, right? We saw there was a concern about U.S. recession, which was kind of likely to be there. We saw sharp rate increases in the U.S. There were geopolitical tension, okay, which was there, and despite that, we saw that the markets really did very well. Also, as we move forward, right, in 2024 calendar year, some of the trends what we see comparing to last year, like last year in 2023, we saw that there were a lot of big themes which played out, the macro trends which played out big time. Like, for example, if you look at few sectors like the capital goods sectors, industrials, the PSUs, the auto sector for that matter, the real estate sector. I mean, these sectors give very large outsized returns, right? Vis-a-vis the Nifty, if you look at it. And so we think that the large, big macro trends, okay, which played out last year, I think that will probably not be the case because a lot of these themes have played out. It will probably be more stock specific as we move into 2024, and that's a kind of a trend what we see. Also, last year the breadth of the market was very big, right? We saw huge rally in the mid cap and the small cap segment. In fact, the mid cap and the small cap indices, okay, gave a return of almost 50%, whereas Nifty gave a return of around 20% or so. So, and the breadth was very good. What it means is that there were many stocks, right, in the BSE 500, okay, which were trading above the 200-day moving averages or made new highs over there. And I think that was as a result of the large euphoria, I would say, the retail money which came into the market. I think this year we think that the large caps segment, if you look at the large mega cap stocks, they are relatively attractive, okay, in terms of valuations. In fact, if you look at the returns in the last 3 years or last 2 years for the large cap, it's mostly come out from the earnings growth, right? Not so much from a P re-rating. Whereas in the mid cap and the small cap segment, 50% of the returns is coming from P re-rating and 50% from earnings growth. So there is good margin of safety in the large caps. So we think that the risk reward going forward is much better in the large cap stocks. Mid and small caps slightly cautious, but from a near-term perspective, you could see more volatility over there. But from a longer-term perspective, I think mid and small caps will also do reasonably well because we are positive on the India growth story, and potentially the earnings growth in the small cap and mid cap would be slightly better than the large cap. So that should compensate for any kind of a higher valuation. Okay, what we are seeing. So and I think again, I think the returns in the market, like this year we're expecting kind of moderate returns because bulk of the re-rating has happened in anticipation. If you look at what drives the market in terms of sentiments are at a pretty high level at this point in time, right? Sentiments are good, so we don't see any further improvement over there. If at all, there could be some disappointments. Valuations are kind of reasonable or slightly above the long-term average, and liquidity situations should continue to remain good. Like this year, again, India remains a fairly good market in a global backdrop where you will see growth slowing down, right? So you will see FI flows into the markets, okay, will potentially continue even in this year. And the biggest trend this year is going to be the talk about or the fact that you'll see interest rates coming down, right? Both in the US, the market is
Indeed, interest rates are going to be in attention, but let's also look at the big E, the E factor, elections as they are lined up. But before that, taking cue of what Mahesh said, 2023 we did see a more broad-based growth versus say just pockets of growth, and it will be interesting to see, especially on the sentiment factor, how things play out. Large caps are seen as something that attention will be played to. But when we look at elections, Mahesh, they often introduce an element of uncertainty in financial markets. So how do you foresee the impact of upcoming elections on the Indian economy, and what strategies can be employed to navigate potential market fluctuation during election years? Because that's something which people will be waiting to watch out for. It's not just election year in India, it's election in a lot of places, the US, the UK. So it's going to be a confluence of factors where there's elections in focus, there's rate cuts in focus. So for any investors who's watching on the sideline, the question will be, how exactly am I going to navigate this terrain? Mahesh will be joining us momentarily to answer that question. And we will, in the meanwhile, have a look at a filler video for you to view. Have a look.
We believe that a determined woman can move mountains, and with wings of encouragement, she can soar higher than ever. We want to be those wings, so she never has to be dependent on others. And that's the thought that has led us to curating India's first women-oriented financial literacy platform. Introducing For Her. So what makes For Her a unique platform for women? It's a one-stop website for women eager to be financially independent. The platform acts as a smart guide to help women not just manage their finances, but also grow their wealth. There are 4 important sections on the site that enable women to get a hold of their finances with ease. Read, watch, listen, and learn. Let us quickly take you through the website so you can get started on making the most of it. To kickstart, all you need to do is create an account by clicking on the Create Account tab. Once your account is created, you would be able to enjoy personalized content through the various sections. Under Read, you can enjoy a repository of informative articles on investing and finance. If you are on the move, you can tune into our engaging podcasts through the Listen section. If you would rather watch, you can click on the Watch section and enjoy a wide array of curated videos. That's not all. You can learn using the learning modules to better equip yourself. What's more, you will get a certificate of completion on successfully taking up a module. The Smart Selfie option under Tools and Calculators lets you create a goal card to help you stay motivated to achieve your goals. You also get to collect redeemable points for reading, watching and listening, liking and sharing the content. These points can be utilized under the Redeem section on the dashboard. The Rewards section brings you a progress report, an overview of your rewards, offers, certificates and more. When you have 1,000 points in your kitty, you can spin the wheel and enjoy an exciting gift such as official merchandise, event passes, ebooks and more. So, what are you waiting for? Step into the world of financial education and learning, one that is made only for her.
All right, let's get right back to the discussion. Mahesh, in response to the first question, you spoke about a more broad-based growth versus, say, pockets of growth. And when we look at 2024, you mentioned interest rates, but let's also talk about the big E factor, which is elections, and elections often introduce an element of uncertainty in financial markets. So I want to understand from you, how do you foresee the impact of upcoming elections on the Indian economy? Because it's not just India, there's globally, there's a lot of elections happening. And what strategies, in your opinion, can investors employ to navigate potential market fluctuations, especially during election years?
Yeah, so you're right. Actually, this is a year where we are seeing almost like more than close to 60% of the world economy, right, going in for elections, and that means that in a way, it one can say it can lead to some volatility, but the way I look at it is that we are since we have elections in most of the large economies, the central governments there will not go in for any fiscal consolidation. That means they would not like anything which will disrupt the economic growth, and even geopolitical risks, okay, which were kind of which is still around the corner. I think none of the governments will try and want to do anything which will escalate that. So that's on the positive side. But as you know, election outcomes are hard to predict. Okay, what will happen, and markets tend to really enter into this the event in anticipation at times, right? So that can lead to some volatility. But what we have seen in the past, especially in India, is that post the elections, even if there is a correction because of some disappointment, the market after the next 6 months usually again bounces back, right? And the momentum what it has built before that in terms of the economy and in fundamental, I think that continues to sustain. So I don't think investors need to be too worried about the election outcome. Okay, it's for long-term investors specifically. Again, to tide over that volatility, I think the best way to is to continue with your SIP or steady investments. And if there is any kind of volatility or a downward correction, I think that can be used as an opportunity. And assuming that fundamentally, I think the economy is in a fairly good shape. And more importantly, I think in India, it's important to notice that in the last 8 to 10 years, we have seen large, big ticket reforms, okay, which have been undergone, and the benefit of that, you will see that going forward now. And any new government which comes in, I think the heavy lifting has already been done, right? So they would probably continue with the same policy. So we don't see any major reason, okay, for investors to be worried. Obviously, pre-election, if there's a rally, okay, then there could be some kind of a sell-off. But again, just continue with your SIP, and that's the best strategy in this kind of an environment.
Absolutely. And when we look at broadly the mutual fund industry, Mahesh, because, when we look at the first 10 lakh crore AUM journey, it took almost 50 years. But when we look at the journey between 40 lakh crore to 50 lakh crore, just a little over a year. So your thoughts on how you see the mutual fund industry evolving to meet the diverse needs of investors? Are there any innovations or changes on the horizon that could impact how individuals approach investing?
So you're right. I think the mutual fund industry itself, okay, is a reflection of how the financial savings are growing, and within that, how equity is allocations is moving up. So if you look at currently, still around 4.5% of the total saving is only into equities, and we see that ratio, okay, starting to increase because the young generation, okay, which is coming in, is probably much more savvier, and they are more exposed to the equity markets, and also the whole momentum by the industry in terms of promoting mutual funds to SIP is gaining momentum. So clearly, I think we see that trend of equity ownership as a percentage of financial savings and overall total savings is likely to go up. And in this process, I think you will see for investors, there are various kind of products, okay, which is there for investors to participate. It's not only equity, it is starting out with debt itself, right? So if you see, a lot of these savings is there still into even within financial assets, to fixed deposits and also into cash, right? And as you know, the return on there's a lot of money which is lying in the savings accounts also, right, for individual investors in the bank savings account. So if you look at on the debt side, funds like liquid fund or liquid plus, which provides similar kind of a liquidity, okay, and less amount of risk or volatility, I think those are also products, okay, which we see can really scale up, where you can possibly get a better return than your savings account, and also get the same liquidity. Apart from that, There are various other products because as investors, okay, want to invest across asset classes, right? Because it's not only equities alone. Okay, we know equities are good for long term, but we think that the return across asset classes, okay, are well balanced, whether it is equity, whether it is debt, whether it is gold. So asset allocation, kind of multi-asset funds, okay, would probably be a good, again, product, okay, which the industries launched some of these products a couple of years back and seeing good traction. That would in turn reduce the volatility of the total portfolio, because some of the asset class like gold, for example, is a good hedge during uncertain times, and with a combination of equity, fixed income, and gold, you can get returns, okay, which are reasonably higher than, say, a fixed income, but overall the volatility is much lower than what you can get from equities. So those products, kind of products, will really see a good traction, and we're seeing good inflows in those kind of funds which are there, and also for products, okay, which are likely to therefore retirement planning, right? Because people starting to now save much early in their whole journey, and they also need to plan for retirement, and there are a lot of products, okay, which are kind of solution oriented products, okay, which the mutual fund industry is now looking at, where once you reach a particular milestone in your life cycle, your needs change, right? You will probably require certain income, which to meet your day-to-day expenses, because when your earning capacity goes down. So there are these solution-oriented products targeted towards people who are likely to retire, okay, in a certain period of time. So all these solution-oriented products, the multi-asset kind of products for on the fixed income side, liquid funds, okay, as a substitute to savings in your bank deposits, and these are some of the products I think which will probably broaden the market and give a lot of options for investors to look at when they are looking to invest into the mutual funds.
All right. I want to narrow the focus of our conversation towards equities in 2024. Are there any specific sectors or themes that you believe hold promising opportunities? You mentioned a focus on large caps. If you can expand more on sectors and themes which interest you in 2024.
Yeah, surely. So, as we look into it, I think one is clear that India, this time around, the recovery, what we are seeing in the economy, is driven after a long time. I'm seeing that after the last almost 10 years, it's been revived by the revival in the investment cycle. So, which was kind of going down for the last decade or so. So, the whole investment, initially, it was more about government spending. We expect the private sector capex to also pick up going forward. So again, a lot of activity happening on the manufacturing side. India is now becoming a destination for a lot of global players to set up manufacturing base, okay, who are trying to really decouple from China. And India itself has a large consumption base. So that's again, a manufacturing is a good theme which is likely to play out. Besides that, industrials and capital goods sector, because as the private sector capex picks up, we think post elections you will see more traction over there. The enabling conditions are in place into the corporate balance sheet is in fairly good shape. So that looks to be a good theme, okay, which will play out. The housing sector has also seen a good recovery. Again, this sector also has since 2012-13. We have seen the sector has been a secular downturn, and post COVID we have seen a recovery over there. That sector also looks promising. Only recently we have probably crossed the peak in terms of housing sales, which we did around in 2011-12. So normally these cycles last for around 4 to 5 years. So probably there is more room and upside over there. That means other sectors which are dependent on housing, like for example cement or building materials, also should do well. Apart from that, as a defensive, we like the pharma sector, because pharma and healthcare specifically, that's a sector which has not done too well in the initial part of last year, because after COVID there was some kind of a slowdown. But again, now we're seeing a steady growth over there, more so in the healthcare sector, like hospitals, where there is been a good increase in terms of the in the overall tariffs, as well as there is some kind of a consolidation which is happening in the industry from a lot of the unorganized sector. And because the focus of the government on healthcare, I think the whole hospital and the healthcare space also looks to be as a good defensive play. And then finally, I would say the whole digital theme, right? We have seen transformation globally, companies trying to move towards digital. Currently, because of the concerns about US growth, there is a slowdown in IT spends discretionary. We think this is a temporary phase. The long-term trends towards IT, towards digital, and also now with AI is taking a lot of center stage. The whole AI implementation and the cloud migration will drive spends in the IT sector over a medium long term. So this is a sector which probably can be a good contraplay. It's a global link sectors, but in this current downturn, I think it could probably be a good time to look at this sector from a say next 2 to 3 year perspective.
Noted, Mahesh. Points to keep in mind for 2024. But structurally, when we look at the market, Mahesh, Indian markets have witnessed significant changes in recent years. So, from your perspective, how does the current economic and regulatory landscape shape the investment opportunities available to retail investors? And what should they be mindful broadly in this environment when they look at the structure of the market?
Yeah, so I think the whole economic framework, if you look at it, that is clearly in a good foundation. We, as I mentioned, the engines of growth for the GDP, right, is not only consumption, right, but even the investments is picking up. Even exports, we think over a longer term, as India takes a larger share of global export, that should also really help. And from a policy standpoint, right, from the government, I think even the RBI as well, I think they are probably going to be in a calibrated manner in terms of how interest rates are interest rate or the monetary policy works. We see that it is supportive for growth. So I think that should really favor the economy, and in turn, we see a good cycle for corporate earnings growth going forward. We expect corporate earnings growth to be around 12 to 13% or the low teens in the next 3 years, which is fairly good in a environment where currently we are seeing global growth is a big challenge. On the regulatory side, I think pretty much lot of regulatory changes on the taxation and other things have already played out. We've seen that last year there was taxation on the indexation benefit on the debt funds or the fixed income products that was taken away. So that to some extent really hurt the inflows or investments into the debt side. But again, alternative there are hybrid funds or the other multi-asset funds, okay, where that investor can really participate in the fixed income space without actually losing out on the tax benefit, okay, which the equity funds would offer. So I think that's one way to really take care of the tax incidents. But I think apart from that, the whole I mean the industry itself, as I mentioned earlier, is coming with various innovative products which are there, which will ensure that there are enough products, okay, to meet any particular investor need, his risk appetite. Also, there's been now we've seen the ETFs or the passives, right? They are also now gaining traction, and a lot of investors, okay, who want to really take some kind of a market exposure or want to play a broader theme can look at some of these ETFs also as a viable option. But for long-term investors, I would say that equity diversified mutual funds will continue to still be the mainstay because of the alpha, okay, which they can potentially generate over some of the passive funds.
All right, Mahesh, before we let you go, your thoughts on the fact that global economic factors influencing markets, how can investors position themselves to benefit from international trends while maintaining a well diversified and risk aware investment approach? Your summary thoughts.
I think at this moment, currently, the Indian market looks to be the best positioned, okay, in terms of the outlook and in terms of a growth. So naturally, one should have a larger focus on allocation towards the Indian markets. Again, there are multiple themes, as I mentioned, okay, which are playing out. It's not like a particular sector is doing well. But having said that, there are some opportunities, okay, for a nuanced investor who has got reasonable exposure to domestic markets, both on the fixed income as well as on the equity side, I would say. So on the fixed income, as you know, in the US or in the developed markets, we have seen a very sharp increase in interest rates last year, right, which were kind of a multi-decade high. And our view is that those rates, as inflation globally starts to come down, you will see those rates kind of moderating down. And we have launched a fund, kind of a US Treasury fund, right, which invests into US bonds with whatever 5-year and a 10-year bond. So we see as interest rates come down, there is a not only you will benefit on the higher return in terms of carry, but also some capital appreciation which could be there. So that can be an interesting opportunity for on the global side to really participate on the duration side and investing into US Treasury bonds, where for the next couple of years, as rates normalize, one can make reasonably good returns. And for investors also who want dollar assets, right, for probably funding their in some kind of expenses in dollar terms. It could be a overseas education for a child. Again, they can look at some of that product. And then on the global front, more from a diversification perspective, I think one can look at some of the sectors, okay, where you can't have a good representation in, like for example, the whole digital space, as I talked about what's happening in AI. So that can be one sector which holds good promise from a, as I said, medium long-term perspective, and one can look at some of these. I mean, Nasdaq is one way to participate in that, and you've seen that Nasdaq after last year's crash has made a very smart recovery. But I think there will be some volatility there, but one can use that to get some exposure in some of these sectors where you have a limited play from a domestic perspective. So I think that these are some of the product things which can complement domestic investors. Okay, besides the exposure you can have into domestic equities.
Indeed. Mahesh, thank you so much for giving us your time on this fireside chat, and of course providing us with the cues to look forward to in 2024. Let's see if the growth in the markets is going to be as broad-based as we saw it in 2023, or are there going to be pockets of growth, especially as we head into an election year, not just for India, but in many parts across the world. Mahesh Patil, thank you so much. Always a pleasure to host you on Nivesh Mahakumbh.
Thank you.
Thank you, Mahesh. All right, time now to move on to our second panel discussion that delves into the theme of navigating the financial horizon, trends shaping 2024. And for this discussion, our lineup of speakers include Dhirendra Kumar, founder and chief executive at Value Research, Meghna Suryakumar, founder and CEO at CreditWatch, Gurmeet Chadda, Managing Partner and Chief Investment Officer at Complete Circle Wealth. And last but definitely not the least, Dr. Jasmine B. Gupta, founder of Make Money. And of course, the viewers will get a full perspective on how this financial horizon can be navigated and what will be shaping 2024. Stay tuned for that. All right, onwards to our second panel discussion, and to set the context as we plunge into the transformative realms of 2024, the financial landscape is undergoing a big shift, a paradigm shift, echoing the pulsating beats of change and innovation. Now, through this discussion, we intend to unravel the intricacies of this evolving financial horizon. And of course, we are in a world which is increasingly being influenced by artificial intelligence, resilient investors, and a growing emphasis on sustainable wealth creation. Now, this discussion will aim to illuminate that path forward by navigating through the comparative analysis of traditional investments and the disruptive impact of virtual assets. And we'll also delve into the challenges of digitization while providing insights into global perspectives, presenting a comprehensive exploration of the trends that will shape the financial narrative in the coming year. So let's kick things off with a question to you, Dhirendra, because in the context of the evolving financial landscape, I want to understand how you see the role of traditional investments adapting to the disruptive forces brought about by virtual assets in 2024. Dhirendra, I believe your mic is on mute. If you can unmute yourself.
Yeah, uh, sorry. I'm very, I'm very concerned about this emergence of this. If you're referring to the cryptocurrency, I'm really concerned, and I feel very happy that in our country we have taken the regulators or the government has taken a view which is able to protect investors and at least people. And I don't consider that as an innovation. I consider as another financial racket which has been invented in this in recent times, and all kind of stories being woven around it. And now I find that we are getting very clear evidence that it incentivizes extortion, crime, and mobility of money. In a country or in all the countries where we have this money laundering act, money moving around, and the ability to check that, and governments responsible for creating that money, they are unlikely to let it go. So that is something which I would like to warn investors to keep wary of, to be aware of that, and be concerned about it. And that is evolving as a very free for all speculative vehicle. So that's fine till the till that point you are keeping it as your fund allocation. As regards financial innovation, I think there is no financial innovation in true sense, because fundamentally it is real assets, equity or debt, whatever form you take, whether you take a mutual fund, whether you take an index fund, whether you take a sector fund, you can call it innovation. But it is basically, if you look at the underlying, it is equity or debt, and you combine it in some manner or the other. And I think investors need to be really, need to be apprised of, the basic principle: diversification matters, equity for the long term, fixed income to provide to gain stability for your overall portfolio, ensuring that you are able to rebalance it, making sure that you are not too concentrated. I think these are inviolable principles, and the moment you violate, it actually becomes an innovation. So be careful, beware of the innovation. Whenever I've thought of or come across innovation in fixed income, it is normally reducing the credit quality to enhance return, and finally it comes to bite you someday. So beware of innovation. Keep it simple. Make sure that those principles are very nicely in place, and you have an advisor who is only reinforcing those principles, and you are asking questions.
Absolutely. In fact, we mentioned this in our first panel discussion, where it was mentioned that boring is good when it comes to investing. So sometimes innovation needs to be looked at with a very cautious lens. Gurmeet, let me come to you. Given the current global economic scenario, I was having this discussion with Mahesh. The rate cuts are being watched. We have elections coming across major parts of the world. According to you, Gurmeet, what asset allocation strategies would you recommend for investors looking to achieve a balance between risk and returns in their portfolio?
Yeah, thank you. Thank you for having me. I agree that, large part of the core portfolio should be simple and boring, and, anything exotic, anything which is flavor of the season, one should be very off. It was crypto a couple of years back, some time back. It was said it's the new dollar. And when Fed really started raising rates, they blamed high interest rates for doing that. So to a certain extent, I agree with what Dhirendra said. I think personal finance. There's a famous quote: "Is more personal than finance." So it's each to his own. But broadly, I think we've had a great 2023. So once you get that kind of a year, it's also important to reset the expectation. It's like a batsman after scoring a 50 or 100 takes fresh guard, and you don't want to get carried away with what you have achieved in the near term, looking at the rear view mirror. So I think two things: if you break it down, let's say in Indian context, and I'll come to global. You've had index giving you about 18%. I'm talking of calendar year, which is Jan to December. You had a mid cap index up 45%, and you had a small cap index which is up 50%. Now, these are not normal returns. Some of it would, if you normalize the index return over 5, 10 years, it normalizes. The gap between a large, mid, small would be at best be 100, 200 basis points normalized over 10 years. So it means two things. A, the large cap can catch up. Second, some bit of pullback can happen. So there is some froth in the market. I'm not saying all mid caps are expensive and all small caps are expensive, but large pockets have some froth, and you have to reset that. Market can also take away. A lot of us don't remember 2017. There was a similar scenario. We had a great year on small cap. 2018, the index was flat, and because of the recategorization by SEBI and AMFI, you lost 20, 30%. So just be careful in terms of your returns, especially the new investors, because you tend to extrapolate returns. On equity, be a little more biased towards large cap. I would say Nifty is still about 19, 20 times versus the index, small cap index being 25, 26 times. Number one. Number two, have some exposure to bonds now. Two very big events which will happen. One is, which nobody's actually talking about, is India's sovereign bond inclusion in the global bond index. It starts with JP Morgan in June, and then there's the Bloomberg bond index where we have a staggered entry from September. Now, this could lead to 30 to $50 billion of passive flows in government bonds. To make it simple, today you get a 10-year government bond at 720, roughly around that. And if, let's say, and then we are expecting some rate cuts this year, probably more in the H2. So if you get some rate cuts, you could see yields dropping between 50 to 100 basis points as a base case, and maybe a little more if inflation is tamed, which means that if you're buying a simple vanilla GSEC or a gilt fund, which has a modified duration of, let's say, 6 to 7 years, you can have a decent mark to market gain. Worst case, if you don't make mark to market gain, you still make 7, 8% on the accrual. So that's something which should figure in your portfolio. I don't mind keeping some exposure to gold with the kind of debt. A lot of these, I don't think so. $34 trillion debt in US is going to end in a good way. Somebody needs to bell this, right? If we continue going like this. So gold could be a good hedge in case we have any financial accident, right? These kind of debts, sometimes can have financial accident. And globally also, be a little wary of export oriented themes. So I would say have a very balanced approach between equity, maybe more biased towards large cap, have some bonds now, include bonds in the portfolio. It's boring, but it could be very rewarding. In fact, the near term returns could be identical between bonds and equity, and maybe some exposure to gold.
Well, a balanced approach is the need of the hour, especially as 2024 lines up to be quite an exciting year with lots of developments happening both on the monetary policy side and the election side. So let's wait and watch and see how things progress from here on. But I want to take this conversation into the direction of financial inclusion as well for a detour. And for that, let me bring in Dr. Jasmine Gupta. Dr. Gupta, in the fast evolving financial landscape, I want to understand from you, how pivotal is financial inclusion, specifically in ensuring access and participation for all individuals, that as Make Money focuses on financial education and inclusion. I thought I'll get your thoughts on this, because we've seen the mutual fund industry grow rapidly and, of course, make wealth for a lot of people. The idea is we also want to reach out to underserved population. So your thoughts on this?
Right. I think the average age of India, as we all know, is like 28.4 years. As per the latest Digital India report, only 24% of India's population is financially literate. Also, if we look at World Bank's Global Findex data, we see that India is one of the 7 countries home to half of the world's 1.4 billion unbanked adults. If we look at the Comprehensive Financial Inclusion Index released by the Reserve Bank of India, we see a positive trend wherein it has improved from 53 to 56 to 60. Also, there are other positives that we see in the environment around us in terms of digital and fintech adoption. India's fintech adoption rate is the highest in the world at 87%. We have 1.25 billion digital IDs, or the biometric IDs that we call Aadhaar. We have 650 million internet users. Hence, I think when we talk of masses, when we talk of the larger segment, including the larger segment of the society within the financial framework, Financial literacy and digital adoption both play a very, very important role. And hence, we talk of bite sized finance. And when I say bite sized, of course, there is a deliberate pun on the word bite, which means BYTE and BITE, which means micro products or sachet products made available to the masses, enabled by technology. So, like for example, in 1970, when single-use shampoo sachets of rupee one each made it affordable and accessible for the masses, the same way, I think sachetization or democratization of financial products is what can bring about a phenomenal change when we talk of financial inclusion. So I think 2024 is all about using digital technology for offering micro products so that the entire bottom of the pyramid can also participate in the financial environment.
That's a great point that you mentioned, Dr. Gupta, especially the financial products sachetization to broad base the appeal of financial products. Because at the end of the day, we also have to improve consumer behavior, right? And when they find these products being accessible and bite sized, they feel that the entry barrier goes down. But when we talk about this digital transformation, I want to explore a few facets on this. Meghna, let me bring you in, because with the reliance or increasing reliance on digitization, the question is what challenges and opportunities you foresee in terms of financial data security, especially with this growing influence of AI and machine learning. We are in a world where a lot more data is going to be exchanged between the customer and the brand, as they say. So your thoughts on how this is shaping up to be, especially the challenges and opportunities.
Right. So, I mean, because of digitization, we have massive opportunity, right? Just like Jasmeet was just mentioning as to how there's an 80% adoption of, financial products and services, and we have the highest rate of fintech adoption in the world, right? That kind of massive scale and digitization also poses many challenges and many opportunities. So let's talk about, challenges first, right? So the biggest challenge with digitization is, threats to data security, threats to privacy, and a lot of, you can say, financial losses that many players can incur because of the threats to cybersecurity, right? So for some of the key things, right, especially with the advent of AI, the reason AI is getting popular is because with the using of AI models, you can actually scale your financial security, digitization, your product adoption, and scale access to services and products at a very massive level, because you'll be able to implement decisioning at a scale. That's what AI does. But with the same thing, while we have this ability to scale decisioning, there's also the threat of something we call model poisoning, which means somebody with a malware, somebody who can come and hack you, can also come and tamper with your model and make you make wrong decisions that can have devastating, consequences, either on the borrower or the recipient of financial services, or for the organization that's providing, financial services. So model poisoning, I think, is one of the biggest challenges that I see, because if there's a threat to data security, right? The second thing we look at is, lot of dangers to a person's financial and personal identity because of the increasing digitization. So again, using malware, if there's if we don't have the right cyber security measures in force, people's identity and privacy can be seriously compromised, right? With the increasing threat to cybersecurity. So another challenge that I see is, how do we ensure that while we have so much data, while learning from so much data, we're building machine learning models, we're creating RPA processes to automate a lot of financial services, even at the basic level. How do we ensure that a person's fundamental personal identity, his financial data security, is not compromised, right? So that's another huge challenge that we see, right? And the third thing is, generally how bad actors coming in and creating a lot of problems in the system per se. So now organizations have to kind of reinvest and rethink and their entire strategy of how do they look at cybersecurity if they increase their digital adoption, right? So these are like three big challenges. And in terms of opportunities, I mean, I see that these challenges can bring in a lot of opportunities. The first opportunity we get is now there's a lot of regulation that's coming in from a data privacy perspective and international regulation. So even if you look at just SOC compliance or a lot of compliances that would, that are aimed at, protecting the identity and financial data of a person who's a recipient of services, then the kind of digitization and the kind of innovative solutions you could bring in for these sort of compliances itself, right, is an opportunity for RegTech. And many organizations, technology companies have an opportunity now to bring in AI itself to ensure that there is, compliance with these sort of advanced regulations aimed at protecting financial and personal data security. Then we look at, individual implementation at an organization level, right? At each data center where, your cybersecurity is being enforced, there is a lot of room for innovation and partnership. So it's not just that you would, not only externally can you partner with people who are innovating, but internally within an organization, you can look at, reinventing the game yourself at your each, individual data security level, right? And also in terms of the, overall creating awareness, the opportunities now for organizations, not only just to provide these sort of data security measures, but also couple that with awareness, right? So a lot of content can be generated, and that could be a lot of opportunity, let's say lead gen opportunities for you to kind of spread this kind of positive content and then also provide a service to this, but a particular group of individuals or groups. So there are a lot of opportunities. And overall, if you kind of look at the digitization, that means there's more and more data available. That means you can, regulate actors. Like, I think we'll talk about things like ESG in the future. But all of this is just, is possible because of the massive amounts of data available and digitization, that we're able to now hold people accountable even from a corporate governance perspective with, regulations like ESG. And only all of this is possible because of the massive amounts of data available today.
Absolutely. Some very important points, especially on the threat aspect. As you mentioned, securing digital identity is important. Data model poisoning is something to look forward to. But it's also good to know that the market is maturing, whether it's from a regulatory perspective or from the corporate perspective, that we now stand to understand the implications of our actions. And I'll come back to you, Meghna, on understanding how AI and analytics can be leveraged to for informed decision making. But before that, Dhirendra, let me come to you, because Value Research is also known for providing in-depth mutual fund analysis. So I want to understand from you how you perceive the impact of artificial intelligence on the future of mutual fund investments, especially in terms of the decision making process.
Yeah, we have been witness to the growth and emergence of the modern mutual fund industry since 1990, and that too on a day-to-day basis. And everything has changed every 3-4 years. But I think we are far off from, artificial intelligence being deployed for investment advice or decision making, simply because, there is real dearth of natural intelligence being applied on a consistent basis for years together. I find that the industry often forgets the basics. And simply because, that is how the financial markets are configured. We get carried away. We get, chasing recent past performance is the norm. Everybody tilting towards a certain asset class at any given point. There will be, so applying basic natural intelligence should be the first goal. I think, what artificial intelligence or all kind of technology enablement, it will be very helpful in democratizing, in scaling up, in becoming, enhancing the acceptance of things. Now in a country where everybody is, able to make a small payment for a vegetable vendor, our ability to participate and our ability to understand, but that actually presents a great challenge in terms of what we are doing right now, to be able to reinforce, because financial education is all about a set of 5-7 principles and about 100 to 200 things which should not be done, and reminding it time and again, because doing the wrong things is actually very tempting, and there is also a very strong short-term case for actually following it. We have seen the speculative bubble emerging in our neighborhood, in the real estate, in the houses, or some assets, something or the other, all the time, and overcoming that and being regular, enforcing discipline. So I think we should just put our head down make things simple, make it scalable, democratize it, and it is happening. If you look at, what has happened, what is the great thing about this, movement towards SIP in a, investors embracing SIP, and now nearly, it should be very, very much close to about 18, 19,000 crore of inflows every month through SIP. The net effect of this regular investment in equity is not choosing a great fund. It is basically participating in equity in a structured, disciplined manner. And in the course of last 2 3 years, it is very hard to find an investor who is disappointed with. There will be investors in good funds, there will be investors in bad funds, but it is very difficult to find an investor who is disappointed with his experience, because everybody is a winner. You don't have to be on the top. You have to really win with your allocation, and you have to be, so keeping your basics in place and enforcing it. You don't need artificial intelligence.
All
This is
right.
a
Let me flesh out this conversation more from a use case perspective, and let me come back to you, Meghna, because CreditWatch focuses on providing insights into credit risk and business health. So, according to you, how can businesses leverage AI and data analytics for informed decision making in 2024, considering this very dynamic economic landscape?
Right. So, with businesses, right, traditionally the way businesses were run earlier, it was a very closed market and everybody knows everybody. But today, when businesses are now trying to expand their horizons and try to scale their businesses and do business with entities that are new to them or not known to them, I think having an insight into who your potential partner or customer is, it becomes really important from a scaling and managing business risk perspective. So what businesses can do now is use these kind of advanced exponential technology to kind of have the right information available to them at the right time. Like, let's look at this, simple thing of a B2B transaction, one business doing business with the other. How do you know that the person I'm doing business with, if it's a new partner, will pay me on time? Because that's, I think, one of the biggest problems in India that all of us face as small businesses. That, in India, the biggest problem is 6 to 10% loss, right, in your entire working capital, what you generate as your receivables because of the delay in terms of getting paid, right? It's something that all of us face, as small businesses, is we always get paid maybe within 3 to 6 months, sometimes more, but never mostly within 30 days. So now, if there are a lot of technologies available now where you can actually do some sort of a mini credit check or credit evaluation of your potential vendor and partner, so that they can anticipate the business days with which they can meet their commitments, and then you can again manage your own working capital cycle better, because every business in India is almost like a lender, but it doesn't charge interest to its partners, right? It waits and collects the invoices. So from that perspective, I think these sort of exponential technologies now available can help you in a simple, intuitive way, because you're a layman, you're not a bank, you're not a financial institution, so you can't have all of that domain expertise. But when there are these sort of simple AI-led solutions available for you, you can at an instant know, how do you kind of manage dealing with a particular partner, based on what the technology tells you in terms of how this partner's current state of health is, right? Those are the kind of strategies business can use in terms, because it's so fundamental that you need to know KYB, know the business that you're working with, and that becomes, and there 80% of the losses or bad events can be mitigated by just knowing what you're getting into, right? So prevention is always better than cure.
Absolutely. And there's an empowerment aspect to this as well, because, for example, when we look at, say, some of the Kirana Walas, they're using dynamic working capital loans being provided to them in the morning, where once they're done in the evening, the loan gets squared off and whatever is left is their profit. It's also, in a sense, change their behavior, change their approach towards financial products, because they understand the context of that financial products in their business, and therefore that's helping financial inclusion as well.
Right.
And speaking of financial inclusion, absolutely getting paid at the right time, right? And it changes according to how your business is progressing, and that's where the AI element comes into play as well. Taking that conversation forward to you, Dr. Gupta, your thoughts on the role that you envision for robo advisors and AI driven financial planning tools in empowering individual investors and promoting financial inclusivity in this new age era. You spoke about the sachetization of financial products. How do you see things moving forward, especially as we venture into this AI driven era?
I'm a big fan of AI driven financial advice and robo advisors. I think it is also important for us to view as to who is the right target segment for these AI enabled products. Now, for example, the rich and the affluent, having been used to financial advice by advisors, would want to continue the same way. But when we talk of masses, and even within the masses, when we talk of certain specific segments, like for example, youth are digital natives. They know the technology, they know how to use the smartphones, and hence, for them, making smaller investments or starting with their first time investments, I think the tools help them get on to the journey faster. So, for bringing youth to the financial world, maybe AI enabled financial products definitely make a huge impact. Contrary to that, when we talk of women, because women is also an excluded segment financially, when we talk of women, and when this is our experience, having launched a financial platform for women, that they will not necessarily be comfortable with a robo advisor telling them how to make their investments, or even understanding investment or recommendations based on their risk profile. I think that is something where women as a target segment need a phygital approach rather than just a digital only do it yourself approach. And that's where we've seen that a human touch or a human element along with a digital product makes sense. So I think customization of the delivery in which we deliver the products to certain target segments plays a very important role. And for the masses, when we talk of the grassroots level masses, what we have observed is not every individual will have a smartphone. In most of the India, especially when we talk of rural India, every family has a smartphone, but not every individual. So, how do we use AI enabled financial recommendations which are focused on household income rather than an individual income becomes very imperative. Yeah, so I think there is a lot of scope for the technology to play for bringing in the masses, but the approach has to be really target segment oriented.
That's a very important point, because the context have of the need has to be zeroed, and you should not just get influenced by the magic of AI and follow the herd mentality. While they say that any advanced science is indistinguishable from magic, I guess in this context the magic of it solving a particular need of that individual, whether they are in a rural area or whether they are in an urban area, that is what will determine the success of technology serving these cohorts. So, moving things forward in this conversation, I want to bring in the ESG aspect as well. And Gurmeet, let me bring you in, because Complete Circle Wealth emphasizes comprehensive wealth management. I want to understand from you, how do you foresee the integration of ESG consideration into wealth management practices, and what benefits does it bring to investors rather than just the hype? What actual benefits is it bringing? Is it the quality of management considerations when folks look to invest? What is it that is at play?
Yeah, I think it's a good one. See, you need to define ESG very well. Unfortunately, what has happened is we have just restricted it to the E part of ESG, which is the environment part of ESG, and not laid much emphasis on the social and the governance part of it, as you highlighted. So, and there's been a fad of only looking at clean energy companies, only looking at non-renewable sources of energy, only looking at EV vehicles over. So I think people have wrongly classified it, white versus black, which I think is not the right thing to do. And I made that point earlier. Whenever anything becomes a fad and only becomes related to that fad, it's easy. So, for example, in India, the ESG funds corpus has grown from about 300 million to about 1.3 billion pre-COVID to now. But if you see last 1 year, that particular theme, the way it was implemented, underperformed the market. In US, for example, 8 out of 10 funds, ESG funds, have underperformed the S&P 500, which is a much broader index. Same is the case for India. So I think you need to define it well. So paint also, for example, uses 20 liters of water, right? So which to me is, other than being water polluting, it water is a very scarce resource. EV, for example, uses cobalt. Cobalt mining largely happens in Congo, where you have child labor issues, right? So you need to have a very balanced approach to it. Need the right marriage between traditional and newer sources. David Solomon made that point, just about a couple of months back, that it's also reliable and cheaper energy and not just clean energy, right? If I'm not able to supply energy at reasonable price, what is the point? And I think West has maintained some double standards on this, which you need to probably dissect. So I think it's important from a risk management point of view, because it entails governance and social responsibility. It's important from long-term delivery for all stakeholders, because if you're really compliant on governance and overall proposition, it benefits every stakeholders and not just confined to it. So we believe in marrying the two well, rather than just being, as I said, very very focused about just the E side of it, which is just plain definition of this is good and this is bad. Look at, for example, last year. Look at UK. UK was the largest producer of steel for 100 years. Today, it hardly produces any steel. With Tata Steel about to shut down, it probably so. And you can't do away with steel, right? So you can decide how to reduce the emissions, how to make it bring more value proposition there. So have a balance between the two, and that is how we lay more importance on the governance part of it.
All right, we have about 5 more minutes left in this conversation, so let's have a round of rapid fire answers. Dr. Gupta, your sustainable finance dominance. So, how can individuals their investment choices with ESG principles, and what initiatives can contribute to this alignment?
Yes, I think educational initiatives are very, very important, because when we are talking of a country where the financial literacy is as low as 24%, obviously the ESG literacy is going to be definitely low. And hence, I think a large population does not know the difference between a net zero and carbon neutral, for example, right? And hence, I think the first step has to be literacy, because only then we can expect the individuals to participate and make informed decisions based on ESG, or selecting companies based on who is driving what. So I think research and literacy is going to be the first step for getting individuals to understand what it is all about. I think companies have largely understood to some extent and mostly have adopted, but for individuals, I think it's a long, long journey for us to take them there.
Miles to go before we sleep, as they say. From demand side, let me look at supply side. Meghna, coming to you, in the era of ESG considerations, how can businesses align their financial strategies with sustainable practices, and what role do you see technology playing in ensuring transparency in these endeavors? Your quick view on this.
Right. So I think technology plays a huge role in ensuring that businesses are getting to be more and more ESG, compliant, and moving towards, zero carbon kind of a footprint, maybe in the next 20-25 years, right? India has a goal in 2035. So, the only way you can be compliant in reducing your carbon footprint is to be able to track with data in terms of every business activity, right? And the kind of impact it has on environment, or socially, or with governance. So I think a lot of regulations that would comply businesses to report, specific ESG related data, very light kind of reporting for smaller businesses, because I think it's important, for every business to kind of be very consciously aware, because everybody is creating individually or as a business a carbon footprint, right? We're all participating in all the consequences that are happening in terms of climate change and the environment. So all of us, I think from a governance perspective, if the government and regulators make, some sort of a very light disclosure requirement of data, right, which businesses disclose a minimum amount of financial and compliance data, small businesses, I think the certain kind of other kinds of data on relating to ESG should be made mandatory to disclose. And for larger companies, I think right now in terms of credit rating and all of that, when you look at larger companies, I don't think that ESG is still formally a part of their overall evaluation. I think that's happening more in the West, where a lot of your funding from certain groups or institutions also directly correlates on your ESG compliance and also your public sentiments. But I think that kind of mainstream reporting of data and using that to kind of, again, govern your behavior and correct your behavior and guide you towards a path of getting to be more carbon efficient, I think is the way to go. And that's kind of what we could do with some amount of light regulation for everyone to be more transparent and aware in terms of what kind of carbon footprints their businesses are creating. That's super important.
Absolutely. I hope, multinationals could drive that change forward, and it's not fragmented, hopefully, and more an ecosystem approach that takes place where
Yes.
everybody wins. All right, as we are in the last leg of this conversation, Dhirendra, to dial back the conversation towards the investment side, as we navigate uncertainties in the financial realm, how crucial is investor resilience, and what strategies would you recommend for investors to build and maintain resilience in the face of market fluctuations? You have about 20 seconds for your answer.
Markets will always be fluctuating every day, and resilience has to come from your habit. First save, then invest, then set your principles and decide what you will never do. And make sure that you are, allocating well, you are diversified, you are rebalancing, and you are not falling for any nonsense.
All right. Always make sense of your investments and don't follow the herd, especially when it comes to something which appears shiny and attractive but could affect your investments in the negative in the long run. Wise words there. Gurmeet, coming to you for the last word. As an investment professionals, how can one stay informed and adaptive, according to you, to the evolving trends in global finance? And what role does continuous learning play in successful wealth management? Your words to our investors, to our viewers, rather.
Understand what you do. You don't have to buy everything, every passing thing in the market, right? And you just need few ideas to get rich. Second, consistency over timing. As Dhinendra made, but I think if you see Virat Kohli is Virat Kohli because he faces about 1,000 balls every day. You can't just get up in the morning and sprint your way up. Thirdly, look forward to corrections. Corrections, they say in Hindi, dhoop and chao, ups and downs. Straight line is when you're dead. Volatility is integral to investing. Look forward to volatility. It's always your friend. Most importantly, in India, for example, we are in a very very sweet spot as an economy. Have the patience and stomach for any things will go wrong. Every 10% once a year, 20% once in 2 years, large once in 5 years. The name changes, right? But be an optimist. To make money, see, pessimism will make you sound intelligent. Optimism will make you money.
Well, we should make a t-shirt out of that. Optimism makes you money. But I think it is a very pertinent point, especially harking back to what Mr. Rao had said on goal, discipline, and patience, the GDP of wealth management, as we go about to make sure that you stay the course when it comes to your investments. But ladies and gentlemen, it's been a pleasure speaking with all of you on this topic of navigating the financial horizon and, of course, the trends that are shaping 2024. Thank you so much for joining us here on Nivesh Mahakumbh 2024.
Thank you.
Thank you.
And to our viewers, it's time now to move on to our penultimate segment of this session. And for this particular segment, I'd like to invite Mugdha Kalra to take over and introduce the session. And of course, our guest speaker. Over to you, Mugdha.
Thank you, Gautam. What a phenomenal morning you have started and had. And I've been all ears, and it's been nothing short of a masterclass. So thank you for that. And moving on, well, in the landscape of financial planning and investments, women often find themselves on the sidelines, facing a notable lack of representation and influence as well. Well, the gender gap in financial literacy and inclusion persists, with many women experiencing limited opportunities to actively participate in wealth creation. And this glaring issue is compounded by a lack of awareness, reinforcing societal norms that inadvertently sideline women from crucial financial discussions. Well, through today's fireside chat, we shall aim at unraveling these challenges, strategizing ways to bridge the gender wealth gap. And we are delighted and honored to have Deepika Jaikishan, co-founder of Basis, a trailblazer in promoting financial literacy and inclusion. With her extensive experience, Deepika brings insightful perspectives on empowering women in the financial domain. Deepika, welcome.
Hi, everyone. Thank you for making me a part of this very important conversation.
Well, Deepika, financial education, as we know, is absolutely crucial in empowering women to make informed decisions. And of course, wealth creation when it comes to women is completely different from that of men. Where do you see us standing as of now? You know, within India, there are so many Indias that exist, and women, and within the women community as well, there are so many sub communities. So, if I were to ask you, where do we stand when it comes to empowering women or educating women? Where are we? And what then led you to take initiatives with your own company to address that?
To start with, Mugda, I would have loved to say that we're far ahead and we're at a place of like, a huge change, but we're not, which is also why it led us to start bases, right? Women are in all kinds of power positions in life, but somehow when it comes to our financial lives, we're not where we should ideally be, right? If we just talk about the literacy gap, we were talking about it in the previous panel, and I was listening to it. So I think the literacy gap itself is so huge for women, right? For women, I think it's about 24%, which is like 24 out of 100 women have basic understanding of financial concepts, which is a huge gap. And as a company, I'm at this point talking about urban millennial and Gen Z women. I'm not even talking about, in the tier three, tier four cities who are working in different roles. I'm talking of women working in multinationals. I'm talking of women working in finance itself who unfortunately are not owning our money. And I'm saying are because I'm a part of this cohort. We're not owning our money. We're not doing everything that we possibly could with it, which is why with basis we said there are primarily three gaps, right? Like there is a trust gap, there is a gap in control, and there is a gap in like autonomy, which is what we want when it comes to our money. And we said if we can bridge this, then we are really getting us across to the other side, which is enabling us. And I'm not a big fan of the word empowerment because it almost sounds like a mission. This is not a mission where 50% of the population in this country by now we should have been addressed or we should have been tapped into as a market by financial institutions. That hasn't happened. So we've taken one step ahead to see the change that we can make and enable women to make better decisions for ourselves.
Deepika, when it comes to breaking stereotypes, what do you see in your line of work, the kind of clients that you have, or the women that you encounter? In your experience, what are the most common stereotypes that hinder women's participation? And
I think the
how can
yeah.
we work to challenge them?
I think the most common one, Mugda, that women are risk averse. At the risk of sounding like, very repetitive, we've heard this a lot. Women are not risk averse, women are risk aware. I think just our life situations make us a little more risk aware than men. There is a certain responsibility financially, whether it's towards our partner, it could be towards our parent, it could be towards our children, which is makes us a little more conscious when it comes to making certain or all our financial decisions. But what we've observed is just being risk aware helps you manage your money a lot more effectively. When you are risk aware, you understand investment strategies a little more deeply. You understand what that your personal risk tolerance is, and each of us have different risk tolerances. Risk tolerance is also a very individual trait rather than a gender specific one, right? So I think this whole gender, just like the default saying, oh, women are risk averse is not true. It's not a gender specific trait. As human beings, we're possibly all risk averse. Like walking out of your gate and stepping out of the road is often a risk, right? You don't want to do it. We're all risk
Right.
averse. Women are risk aware who want to make better, informative financial decisions for ourselves. I think that's one big one. And other than that, there is this like large generalization that women lack financial acumen. That is not true. We don't lack financial acumen. We have lacked access to information to make better decisions. Unfortunately, all the existing content, and for 1 minute, I'll just talk about content, whether it's on fintech platforms, whether it's just just the way the language that is spoken, whether it's in media, it's in the newspapers, online, it's not talking to a women. It's not talking to us in terms of helping us understanding concepts. It's not helping us in building that confidence and knowledge in investment matters. It's not building us that trust by showcasing women, where we're changing some perceptions who of women. Say a woman who's like made amazing financial decisions for herself, who's reached a level of financial expertise. There is no content in the media which is really focusing on these aspects that build on that trust layer. I think where we don't lack
Right.
financial acumen, we lack access to resources that helps us build on that knowledge gap that exists for now. I think these
Interestingly, I
are
also
two
think
last ones.
that,
Yeah,
like you said, women do not lack the acumen, but they sometimes also are not able to take those decisions by themselves. It's so interesting. I know of so many women who make money, but the money is handled by the man of the family, right? So
yeah,
that as well is missing, that autonomy to handle my own money. You see a lot of women who work in great companies, are at high
yeah,
positions, and yet you see them when you ask them, so what does your portfolio look like?
we have
They'll be
no
like,
idea.
that's handled by, yeah, that's handled by my husband, or that's handled by my chartered accountant. So it's interestingly, do you see that in your experience with women when they come to you, are they sometimes also shy of taking decisions independently? Do they need that second person to support their decision? Does that also happen?
It happens too often, Mugda, and it also happens, that need for a second person in all formats happens when you don't trust yourself, and you don't trust yourself because you haven't done this before. This has not been a conversation that happens in most homes. By default, it's the male who's taking care of the money. And here, for 1 minute, I'm not even talking about, hey, say from tomorrow I will take care of my own money. You don't have to do it. What we're saying is just get involved in your portfolio, get involved in
True.
understanding where the family stands financially for your own good. I was reading an article a couple of days ago in one of the leading newspapers. It was very interesting, which talked about women taking charge of their money or taking interest in their money only after the age
Yeah.
of 45. And at the age of 45, a lot changes in your life. You realize all of a sudden that, hey, retirement is not too far away, whether for me or for my partner.
True.
Our children's education, the larger goals are coming up. So let's wake up now and try to figure it out. So all we're saying is you don't have to wait for a certain event to happen
Yeah.
to really shake you up and take control of your money. Start with small steps. Just get involved in conversation. You don't have to tell your husband, hey, I'll take care of the mutual fund investing from today. But it could possibly be, hey, what are we doing? What is our asset allocation? Why did we choose to do this? Like, what are the kind of returns we've made? What are our
True.
insurance policies? Does dad have a will? I think it's simple things like these. When we want
Very
to
true.
make like we want to take giant leaps, but it's only going to start with small steps. And these are the small steps that will really enable us to move ahead.
You spoke about inclusivity in investment platforms, and I think that is another way of including women to make their own wealth and to understand instruments easily. And it is so important to create these platforms and also offerings, right?
Yeah,
I remember being at a conference where there were a lot of women advisors, and they said that the dynamics completely change when a woman talks to a woman financial advisor.
yeah,
They bring in things like, oh, you need to take a sabbatical at this point in time, so perhaps you may want to invest your money here, and at the time when you are not working, uh, automatically this money will work for you. Those
Yeah,
are the things that are missing from our investment platforms.
yeah.
Could you share some of the examples where basis has been promoting inclusivity? Have you worked on something that ensures that women investors also feel that, hey, the platform is user friendly as well, me friendly as well?
Yeah, I'll share the most simple thing here, Mugda, and one of our users actually wrote to us saying, "I love, what you're creating or what you created in the content, because every other default content out there talks to him. An investor is always male. So if you're sharing a story of, like Rahul invested or whoever, by default the language says he. So she was like, just the fact that you'll say she/her is such a huge change where I feel so comfortable in and so I'm okay sharing stuff about my financial stuff here with just addressing me from my gender and not assuming an investor is by default male. And what we also observed and we heard a lot, in fact, which is why we built what we did, Magda, was when women would join Zoom rooms or they would join these conversations on trading or mutual funds or insurances. What was happening was, or probably is still happening, is that men start DMing women on these platforms. They start like trying to add them on other social media platforms, and she's like, I was just here to learn. And even in this space, which is supposed to be a safe space about investing, men are hitting on me or men are reaching out to me like out of context. I don't feel safe, and rightly so, right? And that's not even a financial reason that she's scared of joining a room about money. It's just the way the environment is. So just creating a safe space where she's talking about stuff which is relevant to her. She's learning from experts in the industry, mostly women. So even when we build these conversations for women, we invariably tend to showcase or profile women experts in the industry, because so many exist, but unfortunately aren't given the platform to really rise up and create a larger change. So it's just these smaller nuances. And I was talking to someone recently, and they were like, "Oh, so you dumb down the content?" No, we don't dumb down the content. We make the content relevant to a woman. There is no dumbing down happening here. She needs to be talked to in a different language. Just the way we built our content, for example, was assuming, Deepika is a young mom, like I have a 20-month-old child. If I have to learn something new, I don't have hours to join a Zoom room or go to a class. So we thought about these various personalities, whether it's a 21-year-old, whether it's a 35-year-old mom, whether it's a 45-year-old woman, like managing so many things. She has 10 to 15 minutes in a day to learn a new concept about money. How do we teach her that in the most effective and efficient manner? And that's how we thought about our content strategy and built it. And in these 15 minutes, is she in a better place to choose a health insurance policy? Is she in a better place to understand, ESG investments? Then we've done our job well, and so far that has worked and been like very appreciated.
As we wrap, Deepika, future outlooks, when we look at, of course, creating safe spaces, that is one of the most important things that you mentioned. And when people say dumbing it down, it really is not dumbing it down. It's like explaining in simplified terms. And, if you just want to choose to call it dumbing it down, that's your
Yeah.
outlook. But when we start with simplifying terms, breaking it down in the way, in the analogies that women will understand, much as how you would break a concept for a man in a different way, right? And
Yeah.
some of the things are completely gender agnostic. So, you have to take, as you said, first few steps before you take the giant leap. Some of the future trends and initiatives that you are seeing, perhaps in the industry, which you think will be helpful for women, and how can the industry come together?
I think in terms of the industry, there is a lot that is being done in terms of general awareness. There is a lot more that needs to be done from a woman's perspective. If you talk to any of the leading fintechs in the industry, they will tell you 18 to 20% of our users are women. Chances are, even in this 18 to 20%, those portfolios are handled by the father, the brother, the husband, or someone else altogether. Even if we need to get to like a 35% in terms of like women users across, fintech platforms or women investors in this purely huge mutual fund industry, that there's a lot that has to be done. But the only way to do it is going to be with like sustainable and consistent efforts in terms of mentorship programs. It's going to happen through gender inclusive conversations about money. It's only going to happen by allowing a woman to talk about money openly without having the fear of being judged. And like you said right earlier, that when the women that you were talking to, they somehow feel comfortable talking to other women about money. I think a huge change that we can create is empowering or enabling more women advisors. Because if
Right.
we know this right already, that women are more comfortable talking to women about money, then what the industry should be doing is enabling more women advisors to bring in this sea change or bring in more women investors into your funds or
Line of work, yeah.
insurances,
Okay.
etc. Because women are here to stay. We don't hop onto the next investment product that's giving us a 5% more return. We're very committed to our investments. So by not bringing in this woman investor, the only losers are us industry folks, and that's a huge loss.
Well, thank you so much, Deepika, for that quick chat with us, enlightening us with your insights and also sharing your thoughts with us. This was fantastic. And continue doing the wonderful work that you're doing.
Thank you, Mugda. Thank you for having me.
And therefore, we do see the importance of creating communities, having collaborations, talking to other people about how we can make our portfolios better, learning. Maybe the simplified tools that are being offered to women are actually a great start. And financial education, I definitely feel, should be introduced in schools and colleges, and corporates can actually run programs. With organizations such as the one that Deepika is running as well, where women come and talk to other women about how they can take complete control of their financial uh, assets, but also their education. Well, over to you, Gautam, to take the program forward. And I'm also looking forward to the sessions that are coming up.
Thank you so much, Mugdha. Indeed, this was an enlightening talk between you and Deepika. And as they say, free your mind and the rest will follow. And the point that Deepika mentioned about access to information being necessary for women to make the right decisions to gain financial independence, that is especially paramount in the context of what you both were talking on, achieving equality for women's participation when it comes to investment. So thank you so much, Mugdha, for joining us here on Nivesh Mahakumbh 2024.
Thank you.
All right, after that interesting discussion, let's move on to our last segment. It's time now to invite Saurabh Mukherjee. He's the author of several best-selling books like Coffee Can Investing, Diamonds in the Dust, The Unusual Billionaires, and The Victory Project. And he's also the founder and chief investment officer of Marcellus Investment Managers. And he's here to talk to us about how to strategize investments in 2024. To tell you a bit about Saurabh, he was educated at the London School of Economics, where he earned a BSc in economics and an MSc in economics as well. Now, in London, Saurabh was the co-founder of Clear Capital, and in 2007, he was rated by the Extel survey as one of the top small cap analysts in the UK. In India, Saurabh was rated as the leading equity strategist in 2015, 2016, and 2017 by Asia Money polls. And prior to setting up Marcellus, Saurabh was the CEO of Ambit Capital. So, Saurabh, welcome to Nivesh Mahakumbh 2024. The stage is all yours.
So I've been living in India now for the best part of 20 years. I think it's my 16th year in India. I've rarely seen the Indian economy's macroeconomic outlook being as positive as it is today. It's very rare to see a country where at the top of the interest rate cycle, and we are at the top of the interest rate cycle at the moment. At the top of the interest rate cycle, you have real GDP growth in the 7.5% mark. That's unprecedented in Indian history, and I suspect it's a very rare occurrence anywhere in the world in a free market economy. Right. So if you keep that in mind, that at the top of the interest rate cycle, GDP growth is already pretty healthy. Over the next 2 to 3 years, as interest rates come off across the world, India's economy should improve further. In addition, you have a reasonable amount of political clarity as to how elections will pan out in May of 2024. And the combination of healthy macroeconomy, political clarity, strong balance sheets in corporate India. I think corporate India's debt equity ratio is the lowest it's been in almost 2 decades. Banking system where tier one capital is 17 or 18% amongst, I think, the highest in the world. No large economy will have a banking system with tier one ratios this high. So the overall macroeconomic outlook is incredibly positive, and bodes well for corporate earnings over the next 2, 3, 4 years. Now, if you link the strong economy to the stock market, naturally, if you have an economic outlook which is positive, it boils over into positive stock market sentiment. I think what's further helped India is the financialization of savings over the last 5, 6 years. So historically, as per RBI data, historically around 95% of Indian households' balance sheets were in physical assets, gold and real estate primarily. What we have seen over the last 5, 6 years is gradually part of this massive investment in physical assets. Part of that is turning to financial assets. So my back of the envelope rule suggests that Indian households' net worth would be around $10 trillion. So using RBI data, $9.5 trillion of that would be physical assets. And what we are seeing effectively every year is 1% of that toggle, 1% shifting from physical to financial. So roughly 80, $90 billion a year shifting from physical to financial assets. And as that happens, if you keep pouring in lots and lots of money into the financial system, life insurance, general insurance, mutual funds, PMS, alternative assets, as you keep pouring in financial assets, as households keep saving through the financial system, the cost of capital goes down. So the 10-year Government of India bond yield was in 2003 around the 13.5, 14% mark. Today, that same 10-year bond yield is 7%, right? Sharp drop in the cost of capital. Naturally, if the cost of capital drops in a country, that helps everybody. Lower cost of capital fuels further economic growth. It also fuels the stock market. So strong economic outlook, financialization of savings, constant drop in the cost of capital, good for the stock market. And if you look at large cap stocks in India, large cap stocks are up at 17%, 18% in the last 12 months. That's broadly keeping pace with corporate earnings. So I'm fairly constructive on large cap stocks. Where I think there's a bit of concern is the runaway rally in small cap stocks. I think small caps are up 50% year on year. Over the last 3 years, small cap indices would be up 150, 160%. And that's a cause for concern. I think what's happening is the retail investor is pouring into the stock market, into small caps, and arguably a bubble has built up there, and one needs to be cautious about that. So overall, stock market looks in good place, specifically large caps. Be a little careful of small caps. And if I look back at 2023, I think that's been my big learning, that the economy is in a good place. Large cap companies, well run, large companies, solid earnings growth around the 20% mark. If you invest in them, your portfolio compounding, my portfolio compounding through 2023 in large caps was the best part of high teens, low 20s. But the small cap piece is something I became very, very wary of as 2023 progressed. And by the end of 2023, my view to myself, to my colleagues, to my friends was only stay invested in really high quality small caps, because life has taught me that if in a raging bull market where small cap valuations are running up, but fundamentals are not keeping up, it's a little dangerous to be overexposed to overexposed to small cap, right? Now I'll link that to the broader importance of financial planning, right? I've written about this extensively in my book Coffee Can Investing, the low risk route to stupendous wealth. And one of the things I've written about and tried to practice is that my exposure to the stock market should only be with money that I don't need over the next 5 years. So in Coffee Can Investing, what I've explained is the simplest way to do financial planning is to say, first create a safe harbor. So assume that your safe harbor is roughly 3 to 4 years of annual household expense. So if, for example, if my household expense every year, my wife, myself, my children, if, for example, we need say 30 lakhs a year to live on, uh, my point of view will be, let's put 3 to 4 years of savings in a fixed deposit. So the best part of a crore should go into a fixed deposit. That's our safe harbor. That's the money that we'll take out if something untoward were to happen in our lives. The rest of our savings is what I allocate to equities, right? And I break that equity allocation into 70% large caps, 30% small cap. If you're younger than me, you might want a more aggressive allocation than that. And if you're older than me, you might want a more defensive allocation than that. But the simplest way to go about doing this, as I said, is figure out what your annual outgo is. What's the minimal amount of money you need to live a decent life? Multiply that number by 3 or 4. Give yourself that 4 year cushion. Put that money in government bonds or in FDs. That's your safe harbor. Don't try to make money of that. That's your cushion for a rainy day. Take the rest of your savings and allocate that in broadly a 70-30 ratio. And by all means, use a financial planner. On the SEBI website, I think the 1300 or 1400 registered investment advisors IDs given. Choose a good investment advisor to give you a financial plan so that your equity allocation between large and small caps is done properly. Follow basic financial hygiene, right? So as my friend Monica Alan writes about in her personal finance books. I think Monica has written a lovely book called Let's Talk About Money. Follow basic personal finance hygiene, which is have insurance policy, have a life insurance policy. So my wife has a term life policy. I have a term life policy. Over that basic foundation, build your personal financial plan. Hopefully, Coffee Can Investing, my book, will give you some basic pointers towards that. But my suggestion is get a registered investment advisor to create a financial plan for you. From that financial plan will follow the asset allocation. And so think of a financial plan as almost a GPS map, right? A Google map, right? If you don't know where you're going, then you even if you have the best car in the world, even if you're the best car in the world and you invest in the hottest fund ever, if you don't know where you're going, your car's not of much help, right? Whether your car's engine is 3 liter or 1.5 liter becomes irrelevant if you don't know which direction you need to navigate your car in. Very similarly in investments, it's no point having a high-powered fund with great returns if you don't have a financial plan, right? And in that context, I think Indian mutual funds obviously have become a medium of mass saving in our country, and it's an absolute joy to see the mutual fund industry go from strength to strength, become a medium through which millions of Indian families are able to give voice, give shape to their financial aspirations. Right. So I used to be on the mutual fund advisory committee set up by the regulator. I saw just how committed the regulator is to making mutual funds a safe, well-run, high-quality avenue through which mass savings can be promoted, all the way from a few thousand rupees to crores of rupees. Using systematic investment plans has become the default mode through which households in our country are saving for achieving their life goals. And if you take this further, right, if you look at India over the next 10 years, if the economy continues to grow at a reasonably healthy rate, 6-7% is very healthy by any standards. If 6-7% economic growth continues, corporate earnings at the index level continue to grow at 10-12%. Right? So 6-7% real GDP growth translates into nominal GDP growth of 10-11%. Well-run companies should be able to grow their profits a little faster than that. So 13% profit growth. If you're invested in these companies, your wealth should compound in the low teens. Low teens wealth compounding, apply the rule of 72, tells you that every 4 to 5 years, your wealth will end up doubling. And if your wealth doubles every 4 to 5 years, and you keep stacking up your savings over and above that through augmenting your pot of wealth, you should be headed for a very prosperous retirement. Or indeed, if you have other aspirations such as sending your children for higher studies, buying a dream holiday home either on the beach or in the Himalayas, all of that will work out with a disciplined financial plan. Right. So that would be my suggestions on financial planning, the stock market, and the economy. One broader point I would like to make is, I think it's all very well for people like me to sit in Mumbai and sit in the money center of the country and opine on the market or on the economy, but without financial awareness, without investor education, this message is not propagated out to the public. And I think that's where a lot of credit should go to that whole constituency of people who are taking the message to the masses that if you want to benefit from India's economic growth, come into the stock market through mass financial savings products like the mutual fund industry, and a lot of credit should go to that constituency. And in that constituency, I would also include the Nivesh Mahakumbh, where investor education is propagated the right way for the masses. Thank you very much.
Thank you so much, Saurabh. Cues from the best here on Nivesh Mahakumbh 2024. And well, to sum things up, it's been an exciting exchange of ideas from a galaxy of industry leaders, financial advisors, and subject matter experts like Saurabh as part of this mega event. And on that note, I'd like to thank all of the speakers who have joined us for sharing such valuable nuggets of wisdom here at the Nivesh Mahakumbh to ensure that it becomes a comprehensive guide to reflecting on the lessons of 2023 and, of course, resolving to achieve financial success in 2024. And we hope that these insights will propel you towards a better financial future. And on that note, I'd also like to thank our viewers for tuning in today for this exciting collaboration between Hindustan Times and Aditya Birla Sun Life Mutual Fund. We hope you have a great day and, of course, you are on the path to achieving financial freedom. Take care. Have a good day.